The CFPB is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Ixta Martinez. I am the Associate Director for External Affairs at the CFPB. Today's Auto Finance Forum will feature CFPB officials, federal regulators, industry, and consumer group representatives. Let me spend just a few minutes telling you about what you can expect at today's Auto Finance Forum. First, you'll hear remarks from the CFPB's director, Richard Cordray. Following Director Cordray's remarks, the CFPB's Deputy Director, Steve Antonakis, will introduce the regulators panel. The regulators panel, currently seated, will provide remarks about the ways in which each respective agency approaches its fair lending responsibilities. The next panel will provide on-the-ground perspectives about what's happening to consumers in auto finance markets. Following the on-the-ground perspectives panel, you will have an opportunity to provide comments, feedbacks, and observations. We encourage you to sign up for such commentary as there's still room for comment. Without further explanation, I'd like to introduce Richard Cordray and invite him to the podium.
I don't know that I've ever seen this room look so good. Thank you, Zixta, and thank you all of you for joining us today. We have convened interested parties to discuss what has indeed become a much talked about issue, discrimination that can occur in auto lending. Cars and trucks can quite literally take consumers to new opportunities. Maybe the destination is a new job, or maybe the goal is to save time spent commuting, either to work longer or to have extra time for themselves or their families. For those who live in rural or suburban areas, like I do, a vehicle is almost a basic necessity to get around. Every year, millions of American families buy cars and trucks for all these reasons and more, and this market is very important to our economy. For some consumers, however, that purchase can come at a greater cost. Some people end up paying more on their auto loans than their neighbors, with the difference being not their credit worthiness, but their race or ethnicity. Such discrimination may result in millions of dollars in unjustified consumer harm every year in the auto lending industry. At the Consumer Financial Protection Bureau, we're committed to ensuring fair and equal access to credit. In fact, it is one of our statutory responsibilities as a financial regulatory agency. Over the years, Congress has made findings and enacted laws to identify and root out differential treatment of Americans in the marketplace based on gender, race, national origin, and other protected characteristics. At the Bureau, we're charged with enforcing the laws relating to credit discrimination, including the Equal Credit Opportunity Act. We also know all too well that communities of color were hit especially hard by the recent financial meltdown. While nearly all Americans experienced declines in their household wealth, African Americans and Hispanics felt the steepest drops. They need and deserve to be treated fairly when seeking access to credit. Last year, we issued a bulletin providing guidance that the Bureau would consider evidence of disparate impact as one method of proving discrimination under federal fair lending law. There was nothing new in what we said at that time. In fact, we were simply making the statement that as a new federal agency, we too would be joining with our sister regulatory agencies in the Department of Justice in acknowledging and reaffirming the existing law of the land. From the perspective of a consumer disadvantaged by such practices, it makes no practical difference whether the lender consciously intended to discriminate against them. The outcome and the harm is the very same. We firmly believe that every consumer should have equal access to credit and an equal chance to pursue opportunities. When consumers sit down at the table to discuss their prospects for a loan, they're often unaware of the options actually available to them and are unaware of lender incentives not effectively disclosed for intermediaries to provide higher rates than they actually qualify for based on their credit worthiness. These incentives can result in African American, Asian, and Hispanic borrowers paying more to access credit than similarly situated non-minority borrowers. We have seen this dynamic broadly at work in the mortgage market, and a similar dynamic exists also for auto loans. So what is our role in all of this? Earlier this year, we issued another bulletin to clarify the boundaries of our authority over auto lending and to provide guidance to indirect auto lenders about compliance with the law. Congress has spoken very clearly and very precisely in this area. The law specifies that we generally do not have jurisdiction over auto dealers and their practices, but we do have jurisdiction over the largest auto lenders and their lending programs. We have sought carefully to observe and follow the exact contours of the regime laid down by Congress, and we have noted that we have a clear duty and thus a responsibility to address any discriminatory practices that result from the loan programs established by auto lenders, whether they're lending directly to consumers or instead are lending indirectly through intermediaries. The legal responsibility is the same. And again, from the standpoint of the individual consumer, the result is the same. We know that, like us, many lenders are committed to creating a fair marketplace for all consumers by fighting practices that result in unlawful discrimination. Each lender bears the responsibility for policing its own lending programs to avoid such practices and achieve that result. And it must be said that lenders who turn a blind eye and allow these practices to continue are undermining all of those who are making conscious efforts to faithfully follow the law. So the bulletin we issued earlier this year, in that bulletin, we reminded lenders offering auto loans through dealerships that they remain accountable for complying with fair lending laws in their indirect lending programs. Again, none of this should have come as news to auto lenders, for whom these laws had already been in place for many years, and many of whom had already been through litigation on some of these very points. In that bulletin, we provided guidance to lenders that their markup policies, which allow dealers to exercise discretion over the interest rates they charge consumers and provide direct financial incentives for charging higher prices, may lead to fair lending violations. When lenders provide this type of discretion and incentives in combination, as we've seen time and again in the mortgage market, they create significant risk of illegal pricing disparities based on factors like race or national origin. Discrimination on these grounds, even when it happens unintentionally, causes real harm to consumers and violates the law. So when lending disparities occur among consumers on the basis of protected characteristics, we have an obligation to do something about it. Assessing fair lending compliance poses many challenges, but those challenges are nonetheless part of our job. We've heard from many auto lenders who want to know how they can ensure that their practices are not resulting in unlawful discrimination, and a key element in doing so is ensuring that lenders are aware of the analysis we use to make these determinations. Again, the approach we take to assessing fair lending risks is not new and is already familiar to most lenders who use the same approaches themselves. Our approach is largely similar to those used by the Department of Justice and other regulators. We use proven statistical methods to assess the probability that a particular customer belongs to a particular racial group or is of a particular national origin. We use only publicly available data to determine these probabilities so that anyone can replicate our processes. And our initial analysis thus far raises serious concerns about discrimination in the field of indirect auto lending, which is causing millions of dollars in harm to consumers. In the bulletin we released earlier this year, we provided guidance about steps auto lenders might consider taking to ensure they're in compliance with the Equal Credit Opportunity Act and Regulation B. One approach is to develop robust fair lending compliance management systems to monitor for disparate impact and promptly remedy consumer harm on an ongoing basis when it's identified. The bulletin also stated that lenders could take steps to comply with the law by adopting some other pricing mechanism that fairly compensates dealers for their work, but avoids the fair lending risks that are inherent in pricing by discretionary markup. There may be several such mechanisms that would work in practice: a flat fee per transaction, or a fixed percentage of the amount financed, or other non-discretionary approaches that market participants may devise that would work to address these concerns. The precise details of any such approach bear further analysis, but the central points are twofold. First, we recognize that auto dealers play a valuable role in much of the auto lending that occurs in this country, and they deserve to be compensated fairly for the work they do. Second, we're aware that the structure of indirect auto lending programs can greatly affect the risks of discrimination that harms consumers and violates the law. As we continue to work through these issues, it's worthy of emphasis that alternative pricing mechanisms can compensate dealers fairly and reduce or eliminate fair lending risks. without involving intensive monitoring by lenders of the practices occurring throughout their entire dealer network, and without requiring close and constant monitoring of lender programs by their regulators. It's also worth considering further how the disclosure of markup practices actually works to ensure appropriate transparency to consumers. Individual borrowers perhaps should have a clearer understanding that their creditworthiness actually qualifies them for a lower approved interest rate that in fact is being marked up to a higher rate for purposes of that proposed transaction based on financial incentives to the dealer. For many consumers, that would likely be important information as they consider their credit options. We look forward to the discussions today, which will inform our work and provide opportunities for insight and observations from some of the most experienced and knowledgeable players in the auto lending market gathered here in this room. But if anyone is uncertain about our resolve, let me do my best to dispel that uncertainty this morning. We will make every effort to do the job that Congress has set out for us, which is to identify and root out unlawful discriminatory lending practices, including practices that, in the words of the Supreme Court, are fair in form but discriminatory in operation. We intend to create a fair marketplace for all consumers. Illegal discrimination in all forms is simply wrong. No one should have to worry about having to pay more to finance a vehicle because of race, ethnicity, or any other protected characteristic under federal law. Here as elsewhere, we're focused on making financial markets work better for everyone involved. Consumers benefit greatly from the opportunities conferred by responsible providers, who in turn deserve fair compensation for the work they do to provide those opportunities. We want to see consumer protections and business opportunities work in tandem, and we expect financial institutions to lead through responsible business practices. We believe that such a marketplace will benefit all of us and promote a brighter future for this country. Thank you.
Thank you, Director Cordray. At this time, I'd like to invite Deputy Director Steve Antonakis, who will introduce the regulators panel.
Thank you, Zixta. Good morning, everyone. I'm extremely pleased to have the opportunity to introduce today's first panel, which includes the spectrum of federal regulators and law enforcement agencies with fair lending responsibilities. We expect that each of the panels at today's Auto Finance Forum will produce thoughtful and meaningful dialogue on this important issue. The goal of this first panel is to hear directly from the Bureau and our sister agencies regarding how they each approach their fair lending work. Please allow me to introduce our panelists. In the first row, to my immediate left, is Patrice Ficklin. She is the Assistant Director for the Bureau's Office of Fair Lending and Equal Opportunity. To her left is Maureen Yep, Special Counsel and Manager of the Fair Lending Enforcement with the Federal Reserve Board. Then we have Keith Ernst, Associate Director of Consumer Research and Examination Analytics at the Federal Deposit Insurance Corporation, and Tanya Sweat, Associate Director, Consumer Research and Examination Analytics with the National Credit Union Administration. In the back row, we have Stephen Rosenbaum, Chief of the Housing and Civil Enforcement Section with the Department of Justice. Malini Mithal, Assistant Director for the Division of Financial Practices at the Federal Trade Commission. And last but not least, we have Donna Murphy, Director of Community and Consumer Law with the Office of the Comptroller of the Currency. Assistant Director Ficklin.
Thank you, Deputy Director Antonakis. Good morning, everyone, and thank you for your interest in the important topic of lending discrimination. To echo Director Cordray, the Bureau knows that our common interest, the interests of lenders, advocates, and regulators, is in preventing and addressing discrimination in auto lending. I'm honored to be joined on this panel by colleagues from what I affectionately term our sister agencies, with whom we work very closely on these issues and others. Each of us is going to take a few minutes to talk about the ways in which our respective agencies' fair lending work impacts that common interest. I'll start on behalf of the Bureau. As Director Cordray mentioned in his remarks, the Bureau released a bulletin in March addressed to indirect auto lenders to highlight the fair lending risk created by discretionary markup policies. Specifically, the Auto Bulletin explained that the standard practices of indirect auto lenders likely make them creditors under the Equal Credit Opportunity Act, and that a lender's discretionary markup and compensation policies may alone be sufficient to trigger liability under the ECOA if the lender regularly participates in a credit decision and its policies result in discrimination. By describing the relevant laws and regulations that apply to indirect auto lending, the Auto Bulletin's intent was to help indirect auto lenders recognize and mitigate the risk of discrimination resulting from discretionary dealer markup and compensation policies. That bulletin did not provide new legal interpretation, but rather served to clarify and remind market participants about existing law. I think many of you have seen information that the Bureau released last week regarding our method of proxying in connection with fair lending analyses where we lack self-reported data for race, ethnicity, and sex outside of the mortgage context, such as in auto lending. If not, I recommend that you review the information on our website at www.consumerfinance.gov. I thought it might be useful to use this time to provide an update on the Bureau's work in two areas. First, in assessing the impact of discretionary markup policies in indirect auto lending, and second, engaging in dialogue with indirect auto lenders regarding their ideas for addressing and mitigating these fair lending risks. First, I'll note that part of our motivation for issuing the bulletin was that our supervisory work at that time indicated a significant risk of discriminatory pricing outcomes when lenders maintain policies allowing discretionary markup. I can say that our work is even more expansive in scope today than it was in March, and it still indicates significant fair lending risk for lenders who maintain such policies. In the Bureau's work to date, we have found substantial and statistically significant disparities between the interest rates paid by African American, Hispanic, and Asian car buyers when compared to the interest rates paid by white car buyers with similar credit scores and other factors. We have found numerous institutions with disparities over 10 basis points and several institutions with disparities over 20 or even 30 basis points. Now, if we assume a loan amount of $26,500 at an interest rate of 4.5%, a 30 basis point disparity in interest rate markup means that a minority buyer would pay $216 more than a white buyer with similar credit scores and other factors over the course of a 5-year loan. Harm of more than $200 per borrower can quickly add up to significant consumer harm overall. As I mentioned in my blog last week, what we've already seen amounts to tens of millions of dollars in overpayments each year in total. Across the entire indirect auto market, the total could be much greater than that. The second point I would like to make is that we have been in constructive dialogue with many stakeholders on this topic, many of whom are in this room, and I'm pleased to report that dialogue has often included key industry voices. We have met with trade associations representing auto dealers, trade associations representing lenders, and many individual lenders as well. We remain open to hearing and learning from all concerned regarding this topic. Later today, we will be discussing a key theme from many of these meetings: alternative compensation structures that both reduce fair lending risk and continue to compensate auto dealers for the important work that they do. We are particularly interested in the discussion regarding alternative compensation structures, which I have no doubt will be quite lively. Finally, it's important to remember that discrimination is not just a compliance issue, but also a matter of significant reputation risk and one that can have significant negative business impacts given our increasingly diverse population here in America. We know that many of you are deeply committed to being fair in your lending practices, and we applaud this. Thank you again for your participation today, and to those listening to us live on WebStream. I'd like to now turn it over to Maureen Yap from the Federal Reserve Board for her remarks. Thank you.
Thanks, Patrice, and thanks to the CFPB for organizing the discussion today on this important topic, and thanks to all of you for your time. I just wanted to provide some brief remarks on how the Federal Reserve approaches exams for indirect auto lending programs. We've gotten a number of questions on this, and so I want to address those. The first question that we get is, does the Federal Reserve examine the state member banks for fair lending risk in indirect auto lending? And the answer is yes. We have for a number of years, and we will continue to do that. There is one caveat, though, that with the passage of the Dodd-Frank Act, that the Fed retains authority for ECOA for state member banks of $10 billion or less. So my remarks today are confined to state member banks of $10 billion or less. The second question we get is, how does the Federal Reserve examine for fair lending risk? And here we use the 2009 FFIEC Interagency Fair Lending Examination Procedures, which have long stated the fair lending risks, particularly in pricing. So I'll focus on pricing because that's probably the greatest area of risk for indirect auto loans. So with respect to pricing, we look at three things based on the interagency procedures. The first is the financial incentives. So there is elevated risk if there are financial incentives tied to the price of the loan. Second is the amount of discretion. So there is elevated risk if there is discretion in setting the price. Even if there are caps on the price, if there's still a range of prices based on a single credit decision, then there is elevated risk. And then the third is we look at the disparities. So we review the data and we look for disparities on a prohibited basis in the note rate and as well as separately in the markup over the buy rate. So the third question we get is, how does the Fed code the loans? So as you know, with HMDA, we do have the demographic data tied to the loan, but not so with consumer loans, including auto loans. So there are a variety of very useful and reliable methods. We have selected two methods that we look at that are appropriate for the size and complexity of the state member banks that we have. So the first method that we use is that we geocode the loans based on the majority-minority census tract, and we define that as more than 50% minority within the census tract. We don't view that as a proxy. We view that as reviewing the loans for potential discrimination based on the neighborhood in which the applicant resides. That's the same sort of method that we look at for redlining. So again, we don't view that as a proxy. There is a second method that we used for gender and ethnicity that is a proxy. It is based on the names of the applicants. So we look at the first name for gender, and then we look at the surnames for ethnicity, and we match those to the census list. We have heard concerns about use of this method. We have chosen this method because it's fairly simple and straightforward for our banks to use. Based on our experience, we have found that it's as likely to overcount as to undercount. We remove several of the loans because they don't fit into any particular category based on the census list. And then based on the remaining list, because our banks are smaller, oftentimes we are able to provide them the exact list. And based on their feedback, usually just a handful of loans return as potentially miscoded, and they're as likely to overcount or undercount for a particular category. So based on our experience using this method, we feel fairly comfortable using this method to proxy for gender and ethnicity. Also, for more information on the methodology, we have an archived webinar. We actually have two archived webinars. And so you can go to www.consumercomplianceoutlook.org. That's consumercomplianceoutlook.org. There was a webinar in August with the DOJ, the CFPB, and the Fed. And then there was a webinar last month with all of the federal agencies and one state agency addressing a variety of topics, including indirect auto lending. And as part of those webinars, we provided a step-by-step guide using a very simple Excel spreadsheet that shows how our state member banks can code the loans for themselves to review whether there are potential disparities. And the last question that we get is, how can banks mitigate risks? As I've said, there are elevated risks given certain factors, and what can the banks do? So we do expect our banks to provide controls for these risks based on the size and complexity of the program. So those are the risks having to do with the financial incentives, having to do with discretion, and also having to do with third parties, which are the dealers. A couple of notes on how to monitor for those disparities. We see a couple of common issues or mistakes in this area. The first is failing to monitor based on the portfolio of loans. We find that if the bank is focusing the analysis just on within dealer disparities, that they can miss the disparity that we will be looking at across the portfolio. So that's one area. The second area is that we review the analysis, including the loans that were not marked up. Oftentimes, if the bank focuses the analysis just on the loans that were marked up, this will miss the disparities, for example, if there are markups that are concentrated on a prohibited basis. So that's an overview of our program. It's very quick, but if you would like more information and fuller remarks, then again, please go to the archived webinar to take a look at that. So thanks again for the opportunity to comment today, and I'll turn it over to Steve Rosenbaum from the Department of Justice.
Be here and to see two former housing section employees working for other agencies. Maureen was a housing section employee, and Donna Murphy was a housing section employee. So they don't report to me, but we do have good relationships. We are a little different than the regulatory agencies. We don't have any supervisory responsibility. We are an enforcement agency. Our tool is litigation. That's what we do. I thought I would take a minute to explain how our authority is different than the regulators and how it overlaps, talk a bit about proxy, and then talk a bit about discretion. And I'm going to try and do all that in 5 minutes. I'm a New Yorker. I can talk quickly. So on authority. We have authority for anybody who offers credit who's covered by a COA. We're not limited by the size. We cover direct lending, auto lending. We cover indirect auto lending. We cover dealer activity. We cover whether dealers are financing the loans themselves or they are negotiating the loans on behalf of indirect auto lenders. We cover the whole gamut, and that makes us a bit unique. We have, as you might imagine, sued indirect auto lenders and sued auto dealers. We are looking at, in addition to, we are looking at buy here, pay here lenders as well as indirect auto lenders. I mention that because it's a little different. There we're looking at whether the buy here, pay here lenders are setting themselves up and marketing predatory products to minority customers in minority neighborhoods. That's a little different. Our authority overlaps with the CFPB. CFPB does have authority to bring litigation under a COA. So for the entities that the CFPB covers, each agency has authority to investigate and bring litigation. And the way DOJ and the Bureau are dealing with that is through constant communication, collaboration, and joint investigations where appropriate. So we have an MOU that explains to the world to each other and to the world how we operate, and we are following that. We have a number of ongoing joint investigations in the indirect auto lending space that will ensure that the investigations are informed by our perspective and our experience working in the discretionary pricing space in auto lending, mortgage lending, and unsecured consumer lending, and informed by the Bureau's expertise on consumer issues and through their research and supervision responsibilities. It has been a terrific and very constructive collaboration. And it's happening not just in the auto lending space, but also in other lending spaces where authority overlap. All the other regulatory agencies, including the CFPB, have an obligation under a COA to refer to DOJ situations where they find a pattern or practice of discrimination covered by a COA. And so the Federal Reserve has, years ago, referred to us an indirect auto lender for discrimination, and we ended up filing and settling that litigation. So it's not just the Bureau, it's everybody else as well. A word about proxy analysis, probably more than a word. It's a unique area of the law. I mean, this is a situation Congress put all of us in, the regulators, the enforcers, the lenders themselves. Congress says a COA applies to auto lending. Do not discriminate on the basis of race, national origin. But unlike the mortgage space, Congress doesn't have an Auto Lending Disclosure Act. So we have to figure out whether there's discrimination going on without the benefit of a disclosure act that's based on self-reporting or observation. And indeed, the law makes it virtually impossible in most settings for auto lenders to collect the data. So we have to use some methodology for identifying who in the book of loans is a minority, whether they're white, black, Asian, Hispanic, and then track that through the process. We at DOJ are going to use the best proxy method that we can identify. We have used in the past methods that are similar to the ones that Maureen described, that the Federal Reserve uses. We, in our joint investigations with the Bureau, are using the proxy methodology that the Bureau made public last week, so you all know what it is. And our commitment is to kick the tires on the methodology and on all of our statistical analysis. We want to make sure at the end of the day, we get the answer right. And so we would welcome the indirect auto lenders that we're investigating and anybody else to join us in kicking the tires. But at the end of the day, we have to have a process, a methodology for identifying who the borrowers are and figuring out whether there's discrimination going on. So the methodologies have evolved over time, and we're using what we think is the state-of-the-art methodology right now, but we recognize it's new and we want to hear what people think about it. Finally, on discretion, a COA neither requires nor prohibits discretion in pricing. Let me say that again. A COA neither requires nor prohibits discretion in pricing. If you have discretion in pricing, however, you have a fair lending risk and you need to manage around it. And there are some things that we know from our work in the mortgage lending space, the consumer lending space, and our prior work in the auto lending space, that there are ways to manage discretion in pricing. One is set limits on how much of an overage or a dealer markup there can be. Another is to identify when you can depart from the markup, what the justifications are for either lowering a standard markup or increasing the markup. The one we hear most often is competition. Well, if there's competition that's causing you to lower a rate to be competitive, then the way to manage that is to identify that as the reason, document it, keep it in your files, and produce it internally when you do compliance reviews, and to us or the regulatory agencies when they're looking at you. Whatever the reason is for going up or going down, identify what it is, put it in the file, document it, and make sure that it's not a reason that's prescribed by a COA. So in my 5 minutes, that's about all I can cover. The one thing I would mention that's unrelated to this, but since I've got a captive audience, DOJ also enforces the Service Member Civil Relief Act. If your organizations haven't thought about that in the auto lending space, you should. And with that, I'll turn it over to my colleague, Keith Ernst.
I'm thankful for the chance to share some insights into the FDIC's fair lending review process. Like other agency, FDIC examiners conduct risk-focused examinations consistent with interagency fair lending procedures. As a result of risk scoping, direct or indirect auto lending may be included in the scope of a fair lending review for a given institution. Our analytic approach to the fair lending analysis of auto lending, like that of all lending, depends upon, among other things, the number of loans relative to the number of underwriting or pricing factors in play. We may use statistical analysis or a comparative file review to determine if similarly situated borrowers have been treated fairly. The FDIC has conducted statistical analysis to review denial rate and pricing disparities associated both with direct and indirect auto lending. The primary goal of these analyses is to understand the policies and procedures used by the bank to price or underwrite loans and to evaluate whether objective, non-discriminatory factors utilized in those contexts explain any differences otherwise observed in outcomes. As is the case with all credit other than home mortgages, examiners lack consumer-reported monitoring data and need to utilize proxy methods to identify borrower or applicant demographics. In such cases, FDIC examiners and analysts rely on publicly available data, such as name data from the Census Bureau and from the Social Security Administration. In the process of developing statistical analyses of any kind of lending, the FDIC, as a matter of course, takes steps to ensure reliable results. For example, all results consistent with the finding of a violation are subject to independent replication by a second analyst. In addition, all results of statistical analyses are reviewed by a team that determines whether they believe the results support a finding of a violation. In addition, and prior to any referral to the Department of Justice, the FDIC provides institutions with our results, our data, and our methods. This affords institutions an opportunity to raise questions or concerns with any aspect of our analysis. This input can go to the FDIC's assumptions, our data, or even add to our understanding of underwriting or pricing methods in ways that can lead us and have led us to amend our analysis. The FDIC conducts over 1,500 compliance examinations per year. Our experience indicates that the vast majority of banks effectively manage their fair lending responsibilities for products offered. My brief comments here this morning have touched on aspects of fair lending reviews in the auto lending context, including instances that involve a determination of a violation. It's useful to remember, however, that examiners are asked to evaluate institutions' compliance management systems. As a result, they may identify concerns with fair lending risk short of a violation. In these instances, examiners have a range of supervisory responses available, including, for example, suggestions for improvements to procedures, including compliance management systems. I'll close my brief remarks by reiterating my thanks for the opportunity to share these thoughts. The FDIC welcomes opportunities to discuss fair lending compliance strategies, particularly with its regulated institutions, and continues to look for chances like this to bring greater transparency to our processes. I think that's about what I had to say, and I'll hand it over to Tanya.
Good morning, Keith. Thank you to the Consumer Financial Protection Bureau for inviting me today to participate in this panel discussion. I am Tanya Sweat, the Director of Consumer Compliance Policy and Outreach at the National Credit Union Administration. At the National Credit Union Administration, we are the prudential regulator for federal credit unions in the nation, and we have Consumer Protection Enforcement Authority primarily for federal credit unions under $10 billion in assets. We also insure federal credit unions and are the primary insurer for the majority of state chartered credit unions within the nation. Since the issuance of the CFPB's bulletin in March, questions have continued within the credit union industry about the state of indirect auto lending. So my brief remarks today are focused on that area. The National Credit Union Administration supports the Bureau's efforts to ensure consumers have equal access to credit, including the indirect auto lending market. And based on NCUA's oversight, the practices addressed in the Bureau's bulletin do not appear to be prevalent within the credit union industry. Even so, NCUA continues to monitor credit union lending practices to ensure compliance with fair lending laws, along with the promotion of thrift and safety and soundness among credit unions. As of September 30th, 2013, credit unions reported automobile loans account for approximately 18% of the total industry assets. And of that, approximately 46% are attributed to indirect or outsourced lending relationships. As early as 2001, NCUA issued supervisory guidance to credit unions addressing the risk associated with indirect or outsourced lending activities. While not specifically citing the Equal Credit Opportunity Act, NCUA supervisory guidance notified credit unions that it is a violation of the Federal Credit Union Act to adopt a third party's underwriting criteria without careful and comprehensive evaluation. NCUA reminded credit union boards of directors of their statutory responsibility to establish lending policies and internal controls to ensure compliance with the law, and that includes the Equal Credit Opportunity Act. NCUA has issued regulation since then, and multiple other guidance documents addressing the responsibility of credit unions to perform the proper due diligence and oversight when using third parties to provide financial products and services to their members, specifically indirect auto loans. NCUA advises credit unions that sound business practices include reviewing and testing a sample of individual loans for adherence to approved underwriting criteria to ensure vendor and third-party compliance. Ensuring written policies and vendor agreements require formal written credit union approval of any proposed vendor changes to those underwriting criteria before acquiring any new loans. And discontinuing the funding of loans if a vendor agreement permits exceptions or allows unilateral changes in the criteria. Between 2004 and 2006, NCUA took enforcement action against several credit unions involved in indirect auto lending on the subprime market. The enforcement actions involved a third-party vendor that offered an indirect subprime automobile lending program to credit unions involving every aspect of the loan from beginning to end. The vendor would bring the potential borrower from the dealer to the credit union, provide the loan underwriting criteria, check the loan application, provide for insurance coverage, including credit default or repossession insurance, act as an agent for the creditor in case of default, reinsure the credit default insurer, service the auto loan, and conduct collection and repossession activities in the event of loan default. The vendor charged significant fees to both the dealer and the credit unions for its services. A large number of the indirect auto loans were of poor asset quality and offered little in terms of consumer protection for borrowers. As a result of NCUA's actions, credit union involvement in the subprime auto lending market was significantly reduced, and that vendor is no longer in business. As recently as 2010, NCUA has urged credit unions to exercise the appropriate due diligence and risk management practices necessary to manage an indirect lending program. While there are benefits to a well-run indirect lending program, an improperly managed or loosely controlled program can quickly lead to unintended risk exposure for credit unions, including increased compliance risk and reputation risk. Successful lending programs rely on a well-developed policy and well-developed practices. A credit union's indirect loan policy should clearly establish compliance standards and clear requirements. Indirect lending standards should be consistent with the credit union's direct lending standards. The standards should be reviewed at least annually or more often if risk levels increase or if negative trends begin to surface. To ensure fairness and equal treatment, exceptions to an indirect lending policy should be infrequent. NCUA advises all exceptions should be approved by credit union personnel responsible for administering the indirect lending program and reported to the Board of Directors for review. NCUA examiners monitor credit union indirect lending programs to ensure compliance with the law, as well as safety and soundness principles. Consumer compliance policy and outreach analysts also review indirect auto lending programs to ensure compliance with the Equal Credit Opportunity Act and NCUA non-discrimination requirements. In conclusion, an improperly planned or loosely managed indirect lending program can lead to unintended changes in the risk profile and financial performance of a credit union. It is imperative that credit unions ensure their indirect auto lending programs comply with the Equal Credit Opportunity Act, as well as safe and sound risk management requirements. Additional information on NCUA's indirect lending requirements and the supervisory guidance we've issued can be found on ncua.gov. Again, thank you to the CFPB for the invitation. And at this time, I will turn the mic over to my colleague from the Office of the Comptroller of the Currency.
Good morning, everyone. The OCC considers auto lending as part of our regular fair lending risk assessments and examination scoping procedures for the institutions that we supervise with $10 billion or less in assets. That is because, of course, under Dodd-Frank, the ECOA authority for the over $10 billion institutions is transferred to the CFPB. So I'm going to focus my remarks today on the under $10 billion institutions. In addition to our regular examination procedures, we also review auto finance-related fair lending issues when specific concerns arise in one of our institutions from complaints or other supervisory information. We conduct our supervisory activities in this area under the interagency fair lending examination procedures that Maureen referenced, and she highlighted some of the key provisions of those procedures, so I'm not, in the interest of time, I'm not going to repeat that kind of information. Also, as several of the speakers have mentioned, in the absence of government monitoring data on race, ethnicity, and gender, we use proxies and try to improve our methodologies in order to do the statistical analysis that's often necessary in this kind of fair lending work. And that's, again, I'm not going to repeat the information the other speakers have given in that area, but we do welcome the developments and the improvements that all the agencies are working on in this area, and welcome the dialogue today and on an ongoing basis as we all work to continue to improve our work in this area. What I do want to focus on for a minute is that the OCC, we are currently in the process of revising and updating our methods for gathering information related to our fair lending risk assessments and examination scoping for our $10 billion and under institutions across the board. This process is taking into account changes in the markets, the legal environment, and technology over the past few years. As part of the process, we are reviewing fair lending risk factors that are specific to each type of credit product that our institutions offer. So for auto lending, for example, we're looking at how we gather information on factors such as the use of third parties in auto lending and how a bank or thrift's decision-making is structured, both in terms of the auto loan credit decisions and the various components of its pricing. So we are working to compile this information more consistently across all of our institutions in order to help our examiners better identify potential fair lending issues at the banks or thrifts. At the same time, we expect these process improvements will enable us in the future to do a more comprehensive analysis of fair lending trends and patterns across our supervised institutions. On another area, which Steve brought up, I do want to mention that last year the OCC revised its examination procedures and implemented enhanced examiner training for compliance with the Service Members Civil Relief Act, including the auto finance-related provisions. Our supervisory authority with regard to SCRA extends to all of our institutions, not just those $10 billion and under. And all OCC supervised institutions that make loans that are covered by the SCRA will have that included in their current examination cycles starting this year. So as a result of these examinations, we've begun to work with many of our institutions to ensure that they have adopted and are fully implementing policies and procedures to achieve compliance with the important protections afforded to service members under this act. So time is running short, and I want to leave Melanie some time. So I'm going to wrap up now, but I do want to thank the CFPB and for putting on this forum, to join Patrice in acknowledging the great work that the agencies, I think, do together in this area to coordinate and improve our processes. And I particularly look forward to the discussion today, to hearing from all the stakeholders in the room as we work to ensure better fair lending compliance in the future. Thank you.
I'm Melanie Mithel, and I'm with the Federal Trade Commission, and I want to speak to you a little bit about the FTC's background and jurisdiction before I jump into auto and fair lending issues. So the FTC has broad authority under Section 5 of the FTC Act to bring enforcement actions against companies that are engaging in unfair or deceptive behavior. Now, we have authority over a broad range of companies, including non-bank financial companies and auto dealers. We do not have authority over banks. We also enforce a number of other statutes, including ECOA and TILA and their implementing regs. And indeed, we've brought a number of actions against auto lenders and auto dealers for violations of these statutes. Since 2010, in fact, we have brought more than a dozen actions protecting consumers in auto-related transactions. So like DOJ, we are primarily a law enforcement agency, and we do not have supervision and examination authority. Dodd-Frank did give us one additional tool to combat any unfair or deceptive acts or practices by auto dealers, and that's APA rulemaking, which is a more streamlined rulemaking process than what we usually have. Now, one thing that we've done in the auto area was host roundtables where we examined various consumer protection issues in the auto buying, financing, and leasing process. We held 3 roundtables around the country in 2011, and we brought together industry members, consumer advocates, and other regulators. And one topic that was heavily discussed was dealer markups and fair lending. Now, unsurprisingly, there was not widespread agreement on these issues. Many industry panelists stated that because they are trying to maintain relationships with consumers and because they are in a competitive market, it is unlikely that they will impose high markups or engage in fair lending violations. Others disagreed and noted that anytime there's a discretionary pricing policy, there is a fair lending risk, and they discussed ways to reduce any such risks. They talked about having a more transparent, objective process rather than a subjective process for assessing markups. They talked about having written, firm guidelines that are provided by lenders and dealers so that there is less subjectivity. And they also talked about how it would be in the best interest of businesses to document any legitimate reasons for discretionary pricing decisions. Another topic that did come up related to markups is their lack of transparency. Many noted that consumers do not know there's a markup or that it's negotiable, and this was a heavily discussed topic. So we did hear concerns about markups and fair lending at the roundtables, and just generally at the FTC, we analyzed potentially problematic behavior under a number of statutes, including the ones I mentioned at the beginning. Our main statute, the FTC Act, focuses on whether a practice is deceptive or unfair. And that's a very fact-specific inquiry, but for example, if a dealer made material misrepresentations, that might be considered deceptive, and the FTC would take that very seriously. Indeed, since the roundtables, we have brought a number of cases involving deception. For example, in early 2012, we brought a sweep of 5 cases related to misrepresentations in the auto financing process. We've also brought a case against a buy here, pay here dealer for violations of Graham-Leach-Bliley's safeguards and privacy rules for exposing consumer data in a way that was not safe. We've also brought, just moving away from the auto topic for a second, in the second that I have left, we've also brought some fair lending cases in the mortgage context. For example, we've brought in the last few years 2 actions against mortgage lenders where we allege that the defendants gave loan officers the discretion to charge, in addition to risk-based price, overages that included a higher interest rate and higher upfront charges on an ECOA prohibited basis. We said that they paid loan officers a percentage of those overages and failed to monitor whether Hispanic consumers were paying higher overages than non-Hispanic white borrowers. So that was a very quick update on the FTC, but in closing, I just wanted to say that we support the CFPB and our other sister agencies' efforts to protect consumers in the area of auto lending. Buying and financing a car is often one of the most expensive and important financial transactions a consumer will ever engage in, so protecting consumers here is a top priority for the FTC, and we are very pleased to be invited to speak today.
Thank you for joining us today. Please join me in thanking the regulators panel. At this time, I'd ask them to join the audience, and I would invite our next panel, the On the Grounds Perspective, to please take the stage. As they do, I will introduce them. We have Damon Lester, who is the president of the National Association of Minority Auto Dealers. Rosemary Shaheen, she is president of Consumers for Auto Reliability and Safety. Hillary Shelton, Director and Senior Vice President for Advocacy and Policy of the NAACP. Stuart Rossman, who is the Director of Litigation for the National Consumer Law Center. The Bureau's Acting Assistant Director for Installment Lending Markets, Rohit Chopra, will moderate this panel. Following the panel, there will be an opportunity for comments, feedback, and observations from the audience. The panel after this will provide perspectives on fair lending risk and indirect auto lending, and there will be an opportunity for comments after that panel as well. So without further information, I would ask Rohit to get this panel started. Thank you.
Thanks, Zixta, and thanks to all of you for joining. I think just to quickly start before we launch the panel, thanks to all the panelists for joining us today. The Bureau always looks to approach looking at financial markets with a data-driven methodology. And we know that in the past several years, the auto lending market has rebounded significantly, more than $800 billion outstanding. Majority of consumers are taking out loans to borrow to finance their purchase of an automobile. But beyond the statistics and the numbers, we wanted to hear from individuals who are seeing things on the ground, whether they be dealers or advocates. And so that's the focus of our panel today. In order for us to expedite this, I'm just going to go ahead and ask Stuart to start us off.
Thank you, Rudy. Again, my name is Stuart Rossman, and I'm the Director of Litigation at the National Consumer Law Center. I'm also here today representing Working Cars for Working Families, a program that we have. And although I'm not here in my official capacity, I am honored to serve as the co-president of the National Association of Consumer Advocates. I want to take this opportunity to thank the Consumer Finance Protection Bureau for giving me this opportunity to present today. I think the reason why I was asked to talk is to give somewhat of a historical perspective from the advocacy community. I had the honor of serving as one of the co-counsel in a series of cases that were brought between 1998 and 2007, 12 cases in all brought under the Equal Credit Opportunity Act against both captive and non-captive finance banks and finance companies, representing 70% of the auto loan volume at the time, alleging that the defendants had established specific, identifiable, and uniform credit pricing systems that authorized car dealers to subjectively mark up objective risk-based financing rates. The effect, it was alleged, of this discretionary finance charge markup resulted in widespread discrimination and a discriminatory impact on African American and Hispanic consumers in violation of the Equal Credit Opportunity Act. These cases were class actions. They were brought seeking both declaratory and prospective injunctive relief to enforce the statute. Of those 12 cases, 11 cases settled prior to trial. The 12th case actually went to trial, was successfully tried on the merits, and subsequently settled while it was pending appeal. The settlements resulted in the establishment of rate caps that effectively eliminated the disparity between consumers in the same credit tiers, but still permitted significant markups for all consumers. That was not a perfect result. Nonetheless, the remedy eliminated the subsidization that white consumers were receiving at the expense of African American and Hispanic consumers, which was the best that could be achieved under the civil rights provisions that we were seeking to enforce. The settlements themselves and the caps in particular sunsetted after 5 years. The last one sunsetted in May of 2012. In order to prove our case, we subpoenaed the driver's licenses from the 14 states that then included race as an identifier. This resulted in a production of over 60 million licenses. And because of the mobility of the American population, people moving from state to state, the subpoenaed licenses covered statistically significant populations in 19 more states for a total of 33 states. This information was correlated with the loan applications obtained through discovery from the 12 companies, and as a result, millions of transactions were race-coded, representing between 40 to 50% of the defendant's customers. This information actually was turned over to the Department of Justice at the same time. The statistical results of our statistical analyses were compelling, consistent, and robust in every case, in every state, persistent across every risk-based credit tier. Black consumers in the aggregate were marked up twice as frequently as white consumers with the same credit profile. And when black consumers and white consumers in the same credit tier were both marked up, the black consumer paid twice as much as the comparable white consumer. Slightly less, but still significant discrepancies were found for Hispanic consumers. Those cases all were resolved by 2007. But the market forces that determined what we believe were the discrepancies still exist today. Markups still bear no relationship to creditworthiness. In fact, studies show that they increase the risk of default. There still is no transparency. Consumers do not know that markup is being added to the loan rate which they qualified for based on the credit profile, nor do they know the amount of the markup, either as a matter of the points added or the total cost over the life of the loan. There's no correlation between the points charged and the service provided, especially since the length of average car loans is increasing and the markups apply over the life of the note. If anything, competition between the lenders is greater, thereby giving dealers more leverage in dictating markups and profit margins. The fundamental problems inherent in any compensation system that is based on discretionary markups still exist. Similar to the effects of yield spread premiums on mortgage loans, whenever you incentivize a dealer by providing that they will earn more if they get the consumer to agree to higher interest rates, virtually guarantees that the consumers will overpay and that minority consumers will pay more than white consumers with comparable credit profiles. In this environment, it's incumbent that the CFPB exercise its statutorily authorized duties to monitor the auto finance industry in order to determine whether consumer or civil rights violations are occurring. Private rights of actions, as they existed 12, 15 years ago, may not be nearly as effective an enforcement tool to ensure compliance with the applicable laws as they have been in the past. Even 10 years ago, there were limitations on private enforcement and what it could achieve. Now there are additional challenges. As a practical matter, we are dealing with mandatory arbitration and class action bans which are not giving us access to the courts. There are more restrictive class action rules as imposed by the Supreme Court. There's less access to critical information. Fewer states include race as an identifying factor on their driver's licenses, and we still do not have the HMDA equivalent data for auto loans. The Consumer Finance Protection Bureau, along with the other enforcement agencies, must take the lead. Enforcement of the civil rights and consumer laws under the jurisdiction of the CFPB should not be left to speculation or trust, nor rely upon mere statements of good faith or credence. The CFPB should investigate auto finance loans, analyze the data, scrutinize the results, and when justified, take all steps necessary to protect the legal rights of all consumers. As my colleague Dennis Parker has often said, when it comes to the issue of discrimination and abuse in the marketplace, you can never have enough cops walking the beat. We need the CFPB and its sister agencies to be on vigilant patrol. Thank you very much.
Thanks, Stuart. Hillary?
Oh, thank you very much. First I want to thank Director Cordray and CFPB for bringing us all together to talk about such an important issue that affects so many millions of Americans. Racial ethnic minorities have long been victims of high-priced, often unsustainable predatory loans, including car loans. This is true when we are discussing almost every financial transaction, whether it be mortgages or an auto loan or short-term loan, just to make ends meet, including things like payday loans. Sadly, these high-priced, predatory loans have been a staple in our community for decades. Study after study has clearly demonstrated that even when credit history is taken into account, African Americans and Latinos are largely charged more for homes or auto loans than white customers. This wealth-stripping, immoral, unfair, and illegal practice of charging racial and ethnic minorities more for loans is one reason that it has been so hard for us to build or retain wealth in the past decades. According to a study released by the Urban Institute between 2007 and 2010, African Americans lost an estimated 31% of their wealth. Hispanic families lost 44% of their wealth, and white families lost 11% of their wealth overall. The Consumer Financial Protection Bureau is to be commended for taking actions to enforce existing laws, including the Equal Credit Opportunity Act. In doing so, we commend the CFPB for attempting to bring about fairness and equity in the world of financial services and to ensure no one is abused, taken advantage of, or discriminated against for any reason, including the color of his or her skin. And given the importance of car loans in today's society, or cars in today's society, for people trying to get to work or to school consistently or anytime, by leveling the playing field, the CFPB's actions, if successful, will go a long way towards helping Americans build and retain wealth. Next to a home, a car is the second most important and expensive purchase that a consumer will make in his or her lifetime. In 2007, about 87% of all families in the U.S. owned at least one vehicle. Owning a car is not only useful, but it's helpful to the economy. Recognizing the auto industry has survived through some really difficult times. As you know, we just brought the automobile industry up from the brink of disaster. The automobile industry is a big business. In 2010, the auto industry reported $621 billion in new and used sales, representing 48.3 million units. We must take care to ensure that racial and ethnic minority Americans are allowed to grow and prosper as auto dealers as well, and that we are allowed as equal opportunity for others to perform well in this industry. For that reason, the NAACP has long supported my friend Damon Lester for the great work that the National Association for Minority Auto Dealers has done, and we have watched out for them to ensure that they are allowed to continue to prosper and perform and are not unfairly weighed down by laws and regulations. Nobody should be discriminated against, whether it be the dealers or the buyers. According to the Center for Responsible Lending, consumers who finance their cars through dealerships pay over $25.8 billion in additional hidden interest over the lives of their loans. This is money that could be otherwise used for American families to take care of their business. Furthermore, also according to a study by CRL, a rate markup increases the odds of default by 12.4% and repossession by 33% for subprime borrowers. This means that people who are paying more for their loans are also more likely to lose their cars to default or repossession. As was determined in a lawsuit we heard about earlier, a disproportionate amount, that $25.8 billion was charged to racial and ethnic minorities. The NAACP thinks that this was wrong, and again, we congratulate the CFPB for enforcing the law and standing ready to work with them as they strive to eliminate discrimination. It is because of this ongoing cycle of wealth stripping that is continuing to erode individuals and families and entire communities that we must continue to move very hard and thoroughly to address this issue of discrimination in our automobile loaning industry. So thank you very much. I look forward to our questions.
Thanks, Kelly.
Sure.
Rosemary?
Thank you. I'm Rosemary Shahan, President of Consumers for Auto Reliability and Safety. We're based in Sacramento, but for the record, I want it known that I was born in Ohio, like Mr. Cordray. And we greatly appreciate the role that the CFPB is playing and that other regulators are playing in policing this market. We were asked to talk about what's going on the ground, and in a sense, California is ground zero on this issue because we're the largest car market. We also have a very diverse population, and we suffer the impact more than any other state when there is discriminatory lending. And we applaud the NCLC and the Center for Responsible Lending for the work that they've done in shedding light on the practices and their impact on the public. And California has struggled to address the disparate impact and also the overall impact of dealer markups. We proposed a ballot initiative in 2004 that would have capped the amount that dealers could be compensated at a flat rate of $150. And that polled extremely well, along with other provisions that were in the ballot initiative. So the dealers actually went to the legislature and they said, please regulate us, because if this went to the ballot, it likely would pass. And that version, Governor Schwarzenegger vetoed. But the next year, we reached a compromise with the dealers in 2005, and the Car Buyers Bill of Rights enacted the nation's, I think most, maybe only, I think Louisiana also has markup caps, but California enacted markup caps of 2.5% for loans up to 60 months and 2% for longer loans. And we structured it two-tiered because we wanted to discourage longer loans that added so much to the price of the markups. And at the time, there was discriminatory lending enforcement in the private arena, and also some nonprofit groups like the Asian Pacific American Legal Center had brought a case against a Toyota dealer in Los Angeles. The DOJ alleged was charging Spanish-speaking consumers more than Asian-speaking consumers. It was, I believe, a Mitsubishi dealership. And it struck us that the potential was there for all kinds of mischief when dealers are given discretion, and that they shouldn't have that discretion. We have since this year proposed another ballot measure that's currently pending in California. We just filed it recently with our Attorney General's office to prohibit compensation for increasing the markup. And one reason we want to do that is that not only are we concerned about the disparate impact, but we're concerned about the amount of money that consumers pay in markups that they could be paying to get a newer, cleaner, safer car. You know, I come at this from the safety perspective, and since 1979 have worked to make cars safer. And to me, it's been informative and somewhat dismaying to see how adamantly the dealers oppose improvements in auto safety based on cost. At the same time, they will defend thousands in markup in individual cases. It doesn't square. It really just doesn't square. And we have an interest in ensuring that when consumers buy cars, they actually get the best car they can get for the amount of money they can pay. And typically, car deals are configured around the amount of money consumers can pay that month. And if they're paying it in markup, they're not getting it in terms of improved safety technology. There's another cost here we're very concerned about. I would note that the legislation that passed in 2005 passed overwhelmingly. The dealers made a lot of the same arguments to legislators in California that you're going to hear them make today, that they're still making in the media and with Congress. And at first it was convincing, but over time it got to be less and less convincing. And the markup caps passed overwhelmingly in the Senate 35-3 and the Assembly 65-9. Just to give you one example, and I would encourage the CFPB as it looks at this to look at the impact of percentage rate, and other regulators, to look at the impact of percentage rate markups on motorhome purchasers, because these are large loans where they often go on for a period of 10, 15 years. It's, for a lot of consumers, it's almost like buying a house. And we found one case, for instance, where someone who had very good credit was marked up 3% on a motorhome loan, and over the 15-year life of the loan, it was going to add up to be about $30,000. And I think if you had asked this gentleman, who was an engineer for a major defense contractor, did you intend to give the dealer and lender a $30,000 gift? He would have said no. In fact, when he found out about it, he was really furious, he was incensed, and he paid it off early. I would note that the provision in the initiative that we just filed that calls for banning car dealers from charging extra undisclosed fees for car loans polled at 82% support. And there isn't a whole lot these days that polls so resoundingly well. And I'd also note for the record that AutoNation has indicated that they make on average $441 in markup. And to some people that may not seem like a lot of money, but to a lot of car buyers it actually is. And it's money that could be better spent in other ways. And as Stuart noted, we need help in enforcing existing laws because of mandatory arbitration that all the lenders insist that dealers put in their contracts, or dealers themselves wish to put in their contracts. Private litigation has dried up. The dealers were very active in funding Prop 64, which meant that groups, nonprofit groups like the Asian Pacific Legal Center, cannot bring cases anymore on behalf of the public interest. My organization can't bring those cases as much as we would wish to. So we really rely more and more on public enforcers to help. Thank you very much.
Thanks. Damon?
Good morning, everyone, since I'm the only dealer representative on this panel. But I wanted to thank everyone, particularly the CFPB and Director Corgi, for inviting us here. My name is Damon Lester. I'm the president of the National Association of Minority Automobile Dealers, or NAMAD for short. NAMAD represents ethnic minority automobile dealers in the United States. And so let us begin by saying that NAMAD and its over 1,000 dealerships do not condone or support any form of discrimination when purchasing a vehicle, clothes, or any other product, good, or service for that matter. While we agree with the CFPB that ethnic minorities or any consumer for that matter should not be mistreated in any form of the car buying experience, the process of purchasing a vehicle should not be one that capitalizes off of the welfare of others. However, the car buying experience is an experience of joy. It's fun. As many of you, we use it as a form of transportation. That many people find the necessity to go to and from work, to transport kids to Little League practice, and actually go out on dates. If most of those of you are married and or still courting, so we did, right? So that's what we do. Well, that's the purpose of the car. We show it off. So the CFPB's proposal to eliminate dealer discretion is to protect from discriminatory practices is a broad proposal that may have long-term consequences. While we acknowledge there may be some bad apples, we too are looking to eliminate these practices from the marketplace. It is our mutual or entire industry's goal for all customers to be treated fairly, which is why eliminating dealer discretion will do more harm than good for the individuals we are talking about. So let me share with you a perspective that you may not have considered. Marginal to low credit score consumers may have a difficult time obtaining financing from financial institutions on their own. Banks are not in the business of being an advocate. Dealers are, especially if it means getting a sale and getting a new customer. Because at the end of the day, it's in the best interest of a dealer to not mistreat any customer directly or indirectly. The dealers are here to sell cars, as it is their livelihood, and as well as to service customers. When we start limiting access to loans, sales drop, which in turn means layoffs. And I don't think it's in this economy's best interest to see another downturn in the automobile industry, particularly for small businesses, as we represent minority dealerships who are already disproportionately affected during the economic downturn. In fact, as many of you may know, it is projected that minorities will become the majority population within the next 20 to 25 years. So what should also be a part of the CFPB's goal, as well as the goal of other representatives that's sitting on this panel, along with Hillary and NAACP, is to also advocate for the increase of minority entrepreneurs that will mirror that population. We are here to work with you and all parties involved to come up with a viable and fair solution for the dealer, for the consumer, and for the Bureau. So here's what we think should happen. A uniform data collection program that is statistically more accurate than geocoding and the use of Social Security Administration data. We have already presented to the CFPB the automobile industry-wide expert, which is Polk data, or now called IHS Automotive. This data tracks actual vehicle registrations versus census tract and provides over 85% accuracy in comparison to what the Bureau suggests. And as an example, the lady that was in the panel before us, she used the first name and surname. So for my good friend Hillary, if we use that as an example, right? Hillary is a unisex name, first name, last name Shelton, right? So depending on where Hillary lives, let's say McLean, Virginia, he would be considered Caucasian, right? So what we do and what Polk uses is the data of also looking at first, middle, last name, and geographic location, which is more of an accurate display of what a particular ethnic group or ethnicity is. Our second point that we wanted to bring out is, if the goal of the CFPB is to eliminate dealer discretion and disparate impact, we suggest that dealers adopt, implement, and monitor a fair lending policy that states dealerships do not discriminate. Included in that policy should be a training component for both the dealership employees and the consumers. Resources such as AWARE, which is Americans Well-Informed on Automotive Retailing Economics, is a source that many people use as a source of education. In addition, dealers be required to adopt and implement a markup policy that is consistent for all customers. Dealership employees will be required to document and justify the reason why the markup was lowered. This should be documented in the dealer jacket and signed off by management. This document should include reasons why the customer was unable to move forward with financing, which will mainly be based on price, affordability, and credit. And finally, we are here to work with all key stakeholders to find a solution. And we do ask that the CFPB consider studying the consequences of any new pricing mechanism in this area prior to making a decision, because the very people we're trying to protect could be harmed. Thank you.
Thanks, Damon. So we have some time for questions now, and I thought I'd start, since a number of you mentioned data. How do you think the regulators and others should balance the industry burden of data collection versus ensuring compliance with the law, especially given the absence of a Home Mortgage Disclosure Act type regime in the auto lending market?
I would say very generally, it has to be done consecutively. It has to be done together. If we're going to manage this problem, we have to clearly measure it. So it means that data collection has to be consistent with any changes that we make along those lines.
Well, NCLC has been on record at Congress saying that the authority should exist under Reg B of the Equal Credit Opportunity Act to allow the kind of data collection so that it's not a matter of hypotheticals and speculation, similar to the practices in the mortgage industry. Collecting the information at the time of the transaction itself will ensure that we will be able to have accurate and up-to-date data available to be able to make those determinations on a real-time basis.
I would say, for a car dealership, the difference from a mortgage loan, mortgage applications, you can disclose what the particular race or ethnicity is. Car dealership applications do not. It's prohibited. It was already part of the, I can't think of the name of it right now, but you cannot disclose what a particular race or ethnicity is on a car application. However, the data should be uniform, which should be fair. I mean, the process, what has been proposed and has been discussed, I would think is definitely not one that is fair for someone like myself who is part of the protected class and the consumer. And I think we really need to look more at the consequences of making sure the data collection is accurate, because it can do, again, more harm than good.
Just follow up one additional point. There's a unique feature of the Equal Credit Opportunity Act. There is a safe harbor provision which allows any creditor subsequent to the transaction to be able to go back and analyze the effect of their lending policies and have the opportunity then to be able to change or amend those policies if in fact they're resulting in discrimination without exposing themselves to liability. That feature has existed, and that allows, I believe, once again, the individual who has the best opportunity to collect the data, which is the point of sale individual, to be able to collect that information without violating the law, and nonetheless be able to modify their policies in good faith when, in fact, inadvertently they result in a disparate impact.
So where do you guys all see the future of the indirect auto channel? Or what do you think it might look like over the course of the next several years and in the long term? And what would you like to see change or stay?
I would say that the person-to-person interaction has to be key. And if we go to the point where if you think about in the age of using the internet and trying to apply for a loan, in many instances, if you have a blemish on your credit, you're not going to get approved. And that's where the benefit of being a dealer and having that one-on-one interaction, because in the scheme of things, when you look at what a dealer does, a dealer uses his relationships with the bank to make sure that, one, that customer can walk out with the vehicle that they can afford, as well as the price point which that customer wants to pay. And I think we need to really be cognizant of that if you remove that interpersonal relationship in which someone will be able to come and actually advocate on behalf of the customer and utilize his relationship with the bank. And mind you, a dealer actually has an asset base, which is called their floor plan, that they use as a way to get rates bought down with the bank. So that is something that I think everyone needs to be mindful, is that this is a relationship type business.
Rosemary.
I have a somewhat different take on it, and we really encourage consumers to shop for financing before they go to the dealer. And we do hear from consumers who are told that they can get a better rate then they bring into the dealership, and then they get yo-yoed. And if you're familiar with yo-yo financing, it's basically bake and switch, where they come in, say their lender would give them 6%, and the dealer says, well, we can do 4%, and then they get yo-yoed to 10. So it's just a risky environment for consumers, and that's why we really encourage them to shop on their own and not necessarily take the dealer's word for it when they say they can give them a better rate.
Just regardless of the lending package, wherever the lending source is, it has to be fair and non-discriminatory.
I just think that anytime you have a system where someone's compensation is based on incentivizing them to raise the interest rate is one that's fraught with problems. And I think that the elimination of the discretion is imperative in this set of circumstances. I just want to respond quickly to Damon's point that if someone is marginal in terms of obtaining credit, they're the last person in the world that you want to be adding additional points that are not related to risk to their cost, which is the reason why, as we will hear later, the default rate gets so much higher on it. That's at a situation we want to ensure that it is the most affordable, not the most expensive for a person over the course of time. We certainly believe that dealers are entitled to get compensated with a reasonable profit for the service they provide, but that service, as is this case in yield spread premiums, should be directly related to the quality and the quantity of assistance that's provided to the consumer. And at this point in time, there is no check on that.
At this time, we're going to open up the floor for comments from the audience, and we have a number of folks who have signed up. I'd like to hear from everyone that signed up, so I would encourage you all to please aim for 2 minutes. Our first person is Randy Henrik with Dealer Track. Randy, someone will bring you a microphone.
Thank you. Before I get into my substantive remarks, I just want to respond to a couple of things that were said. Stuart, you conveniently omitted one condition of the settlements, which was to indicate on contracts that dealers share in the rates that are charged. So there's no hidden interest in subprime borrowers. It's right there in the contracts. There's no wealth stripping. It's funny, you guys love to go after auto dealers, but you don't go after other industries. Auto dealers sell 2 things. They sell vehicles and they sell credit. And you don't go into Walmart and say, I want to know how much you marked up a raincoat or a television set. But you go into auto dealers and you want to know how much they mark up, and somehow that's wrong and that's discriminatory. AutoNation says it makes $441 in markups. Flat fees, which has been one of the things suggested, will not eliminate dealer discretion. It'll give dealers the ability to have discretion, and to the extent that the CFPB's position on discretion is correct, it will continue that discretion. As far as the yo-yo financing goes, that's overstated. The number of spot delivery deals where the consumer is putting the vehicle on the spot is much less than what you've said. There have been studies on that. We at Dealer Track appreciate the opportunity to appear at this hearing, and we share the CFPB's goal of non-discrimination in indirect auto financing. We share the Bureau's belief that fair lending and the legitimate business needs of competitors are compatible. And what we would urge the Bureau and the other regulators attending today is to look at solutions that do eliminate or minimize dealer discretion. We don't think that flat fees do that. A proposal such as the type that my friend Damon Lester indicated, where dealers would be applying a universal rate unless they had a competitive and a legitimate business purpose, which is authorized by an ECOA disparate impact analysis, and documented that in the file, would eliminate dealer discrimination. And we at Dealer Track have a comprehensive compliance program for auto dealers, and we've proposed such a solution. We'd like the CFPB to consider that as one way to eliminate dealer discretion. The flat fees are going to reduce competition because the dealers wouldn't have any discretion to mark it down. In 2011, when I testified before the FTC in one of their roundtable hearings, we polled a number of our large lenders, and 2 large lenders in the Midwest told me that frequently the dealer rate was cheaper than the rate that the customer could get directly from the bank. A dealer buy rate is a wholesale rate. You don't get to buy a refrigerator at Walmart at their wholesale rate. You don't get the credit at a dealer's wholesale rate unless the dealer needs to do that for a
Thank you,
legitimate
Mr.
business
Henrik.
purpose. Thank you.
Matt Thomas with the National African American Chambers of Commerce.
Thank you. Thank you. I appreciate the opportunity to share my comments with you. Mr. Lester, I also appreciate your sensitivity to the particular needs of the African American car buying public. However, what the National Association of African American Chambers is just asking for is the level playing field. And although your NAMAD certainly may show a little more sensitivity to our needs, you're just a small percentage of the dealerships that our community deals with across the country. And we are seeing a lot of disparity when our members are buying cars. So we support eliminating dealer discretion and would like to have a conversation on how we can improve the auto buying experience for African Americans. Thank you.
Thank you, Mr. Thomas. Andy Koblitz with the National Automobile Dealers Association.
Again, thank you for the opportunity to speak today. A number of people have commented about the need for data, and we appreciate the agency, CFPB, as a data-driven data, and we encourage decisions to be made on data. But over the last 24 hours, there's been a lot of talk, it was mentioned here this morning, of some numbers that we don't think are real data. And the number and it's a big number, and it gets a lot of people's attention, which is the $25 billion. Americans are paying $25 billion more every year because they get their financing at the dealership. That sounds horrible, but it simply isn't true. First of all, that number is when you look to the reports that state that number, the mathematics are just flawed, and we can share that. Secondly, so the actual number that dealers get compensated for is much lower. But secondly, that number is all dealer compensation. I believe Mr. Cordray said one of his principles said dealers deserve to be compensated. So we can't say that Americans are paying more when that is a compensation that even the CFPB acknowledges the dealers are entitled to receive. And finally, and perhaps most problematically, when we say something's more, it's got to be more than what? More than something else. And the issue here would be more than you can get from the other lenders out there, from the other sources. And has anyone looked at that? Has anyone asked the question, are people paying more than they would if they got their financing elsewhere? We have, and the answer is no. In fact, the evidence, the data that's there says that they're actually paying less. And that's the kind of questions that the CFPB should be asking. Are we comparing actual apples to apples? Are we looking at the amounts that are being charged elsewhere to the amounts that they're paying at the dealerships, similar situated people, to find out at the total rate, not just the dealer participation, but at because the dealer participation is just a part. If you're not paying more in your APR, similarly situated, then you're not paying more because of dealer participation.
Thank you, Mr. Koblitz. David Berenbaum with the National Community Reinvestment Coalition.
Thank you, Zixta. And I just want to comment, really a reaction to the first two panels. The level of the discussion has been wonderful so far. First, Damon, Mr. Lester, to your point, if we make an analogy between years of analysis on Home Mortgage Disclosure Act data, to potentially more sunshine on automobile financing, in fact, income is not a factor. The levels of discrimination against upper income African Americans and Latinos is quite extreme. And while I applaud your statement about access to credit, the real issue is eliminating discrimination and using a COA here. I want to comment and applaud the efforts of both the Center for Responsible Lending, the NAACP, as well as the National Consumer Law Center, because Congress should, as they have done with HMDA, as they are now directing the CFPB to do with small business data, we need similar sunshine on actual lender data so we can see what is going on with all members of our society. I agree, we're in a much more diverse community now, and we need to be sure for our economy's sake that all consumers are treated equally and fairly. From another perspective, as a national housing counseling intermediary, last year NCRC and our 160 affiliates counseled over 50,000 consumers. This year the number will be going up to 75,000. Often in counseling these consumers, whether they be young college graduates looking to find their first home or apartment, or seniors looking to age in place, adults looking to sustain their home ownership, what we see now is student loan debt and automobile debt are the second and third most frequent warning signs in fact, providing consumer credit counseling to these consumers. And frankly, from our analysis of FICO, and we usually run FICO or credit scoring data for most consumers, we question the appropriateness of some of the numbers that we are seeing in the auto finance space.
Thank you, Mr. Berenbaum.
One quick point before I close, and that is also acting as a private attorney general. We believe that one of the best practices or one of the enforcement mechanisms that should be used is fair lending testing. In fact, the industry already uses mystery shopping, but I question if they're really using it to look at ACOA issues. Thank you.
Ellen Taverna with the National Association of Consumer Attorneys.
So I just wanted to thank the CFPB and the other federal regulators for looking into this important issue. So I just wanted to raise the fact that, as we've seen with the NCLC lawsuits and NACA, our NACA attorneys have experienced the same type of markup abuses that have been reported on, and we continue to see. And so we look forward to what the CFPB efforts bring to light with their oversight and their supervision in this area. That's all. I really wanted to thank the CFPB on this issue. And
Thank you, Ms. Taverna.
Yeah.
Enrique Lopez Lida, National Council of La Raza.
Thank you. We want to thank the CFPB for this forum. We want to commend them for their efforts through the indirect auto lending guidance they put out. NCLR, like NAACP, has been working on this issue for many years with NCLC during the cases. And our vice president co-authored a bipartisan report recently on CFPB, where the report concluded that the Congress should correct the mistake of carving out dealers from the supervision of CFPB. But even without that authority, we believe the CFPB could do more. They could use a rulemaking authority to squeeze out the markups. We believe they can collect the data and analyze it, issue a report. And so there's more that can be done, and we look forward to continue working with CFPB as a partner and a supporter in this important issue that affects Latinos and other minorities.
Thank you, Mr. Lopez Lida. Randy Dennis with the National Association of Consumer Attorneys. Okay, that concludes our comments from the audience. Please join me in thanking our On the Grounds Perspective panel. And at this time, I'd like to invite the next group of panelists. These include Bill Himpler, Executive Vice President of the American Financial Services Association, Chris Kukla, Senior Counsel for Government Affairs at the Center for Responsible Lending, Paul Mitri, Chief Regulatory Counsel with the National Auto Dealers Association, Richard Reese, Senior Vice President, Center for Regulatory Compliance at the American Bankers Association. The panel will be moderated by the CFPB's Associate Director for Research, Markets, and Regulations. Following this panel, there will be an opportunity for comments, feedback, and observations from audience participants as well.
Thank you, Zixta. So this panel gives us an opportunity to hear from diverse perspectives on the policy and perhaps legal questions that have been discussed this morning. We'll start with Bill Himpler, the Executive Vice President of the American Financial Services Association.
Thank you, David, Zixta, Director Cordray, and the entire CFPB team.
Let me state at the outset that I hope we can keep the trend going, that we can get the same compliment from Mr. Birnbaum after our panel as the first two panels did. The American Financial Services Association represents lenders in the indirect auto financing arena. Our members rely on dealers to assist in this financing to the consumers. I don't think anyone today so far has disputed the efficiencies built into this indirect lending model. In fact, 80% of all auto sales finance is done indirectly. You can see the benefits to indirect financing and the fact that the auto dealer deserves to be fairly compensated for the work that they do. In fact, the director mentioned that in his opening remarks this morning. This system of financing cars has withstood recessions and downturns consistently over the last 50 years. In fact, during the Great Recession that we just experienced, the auto financing sector has stood as a shining example of how credit markets should work. In fact, today, the automobile industry continues to lead the economy in growth and job creation. Now, some might contend that success in an industry does not equate with customer satisfaction. J.D. Power reports that auto-related complaints are at record lows. In fact, the Bureau's complaint database from our assessment shows that very few complaints are in the auto space as compared with other areas of consumer credit. In fact, by our assessment, they amount to less than 1/100th of 1% of all auto loan sales. This is the backdrop that we are working in today to talk about potential changes to this credit model that has proven successful for decades. We stand with the director in his letter to 22 senators recently when he stated the commitment to ensuring that credit markets function competitively and efficiently for all consumers. At the same time, we think there's a need for greater transparency in this area, and today is a very good start. Like the senators and representatives that have expressed their concerns, we too are concerned that the CFPB's allegations of discrimination are troubling in light of the fact that there's no basis that's been provided to policymakers that have asked them about this. In fact, one letter stated, without complete information, we cannot know if the CFPB is faithfully executing ECOA protections against discrimination, or if the Bureau's guidance is unnecessary or, in fact, counterproductive. We couldn't agree more. Let me be crystal clear. Auto lenders take allegations of discrimination very seriously, and this is a very important forum to have, and we commend the Bureau for doing so. We represent lenders with national scope and international scope that have the potential for significant reputational risk in this area when allegations of discrimination arise. If there is a problem that we can fix, we want to fix it, plain and simple. The Bureau in its guidance has offered two particular suggestions: dealer monitoring or flat fees, with a bias towards flat fees. The industry has concluded that this fix is not as simple as some would have us believe. In fact, many of our member companies believe that moving to flat fees could actually create disparate impact by doing so. The Bureau, in this, the director's response to 22 senators, admitted that it had not analyzed how a change to a flat fee structure would impact consumers, lenders, or the overall economy. Will this suggested cure kill the patient? We simply don't know. We do know that these issues are complex. The director at our last meeting with him last month, it admitted as much, that any change needed to be studied fully and vetted carefully before being implemented. Since the Bureau has not studied the impact of these suggested changes, AFSA announced this week that we are commissioning an independent study which will assess the present model and evaluate the costs and benefits of alternative models that have been proposed. Without this important analysis, it's like putting the cart before the horse. Thank you.
Thanks. Chris Kukla from Center for Responsible Lending.
David, thank you. I'd also like to thank the Bureau for giving us the opportunity to present here today. And we also want to make sure to applaud the Bureau for their guidance earlier this year on ECOA. We firmly believe that there's no place for discrimination in our lending markets, and we believe that robust enforcement of our fair lending laws is vital. And so we appreciate the steps that the Bureau has taken in this regard. The practice of dealer markup has a long history of discriminatory impact. We've heard a little bit about that earlier on an earlier panel with the litigation that occurred starting in the late 90s, early 2000s, and it's continued. We also have extensive experience with this in the mortgage market as well. Discriminatory practices in the mortgage market related to discretionary pricing had a disparate impact on borrowers of color, and it was substantial. Our experience with this pricing model, which allows someone to add to the interest rate that is based on factors that are outside of the risk that the borrower presents, lends such a pervasive risk of discrimination that we frankly think it needs to be removed from the marketplace. What does that mean? It doesn't mean that we're saying that dealers should not get compensated for the work that they do, despite folks that say that we do. We believe that that's true. What we believe, however, is that this particular compensation system gives such rise to this level of discrimination that it should not be a part of the system. Prior research showed significant disparities, and there is strong indications that the discrimination still exists. As such, regulatory review of fair lending and a broad discussion of the structure of the market is essential in a market like this for a couple of reasons, one of which is that there's a significant lack of transparency. As mentioned earlier, there is no meaningful ability for consumers to determine what part of the interest rate actually is reflective of their risk versus what part of the interest rate is reflective of compensation. And in fact, survey after survey shows that consumers are unaware of this practice. Even though we've heard someone say earlier that it's disclosed on the retail installment contract, it's important to remember that that contract is usually signed at the end of the process, where after negotiations on the price of the car and in fact even discussions on the interest rate occur. So it comes late in the game, but even with that, surveys show that consumers are still vastly unaware of this practice. The practice of getting a loan is also difficult, particularly within a dealership situation, because you not only have to go through the process of negotiating the price of a car, choosing the car, and having discussions about the value of a trade-in and any other factors before you get to the loan transaction, after which you've been in the dealership for a good long time. Furthermore, it subjects a consumer to potentially misleading information that could be presented to them, and which we see is pervasive in the marketplace as well. And in fact, the price compression on cars actually shows what transparency can do. For consumers, the amount of information available on the price of a car is more robust than ever. The internet has provided substantial information to consumers that have allowed them to be able to negotiate effectively on the price of the car. Lending is different. Lending is personal. Two people walking into a dealership will likely see the same price, but on the price of will at least see the same sticker price on the car, but lending pricing is different. We also have research that we are going to be releasing next week that indicates that these disparities still exist, but it also suggests that shopping and negotiation does not mitigate that risk. Shopping and negotiation is touted as one of the ways to ensure that someone gets a lower interest rate, and yet we find that that may not necessarily be the case. Because of the history and recent evidence, it's difficult to fathom how a compensation system that allows discretion cannot ultimately lead to discriminatory impact, and for that reason, we feel strongly about it. And further, the regulatory resources that would be required to ensure fair treatment do not seem to be justified by any benefit of that system. I want to talk briefly about the number that's been presented, the $25.8 billion number. We use that number in order to try to quantify the impact on the market of this practice. By no way did we say that necessarily that this would be compensation that would not be charged to consumers, but we wanted to make it clear what size this marketplace would be. We are aware of the concerns about our methodology. We've reviewed them, and we believe that those concerns are unfounded, and we stand by our research. Furthermore, other forms of compensation already exist and are in use. NAF does a regular survey of lenders that we believe actually is a fair cross-section and shows that many lenders compensate dealers in other forms along with or instead of dealer reserve, and in fact, 1/3 reported that they didn't use dealer reserve at all. In fact, the incentive to find lower cost financing will still exist. The argument that this will increase costs or reduce access to credit, we believe, are specious. and frankly are arguments that are routinely used by entities that are trying to avoid regulation in their marketplace. In fact, CEOs of publicly traded dealers indicated that changing from a dealer reserve system to a flat fee or other system would likely have little to no impact on their dealerships. Furthermore, assuming that markup represents the high watermark of compensation, then that cost is already reflected in current interest rates, and therefore that given the evidence that markup may actually cost some folks more than it would than another compensation system would, leads us to believe that the arguments that the cost and access to credit would disappear. I know I'm being told to wrap up, so I would like to say that this is an issue that is of grave concern to us. We have fought long and hard to preserve access to credit and access to wealth in underserved communities, and we believe that this is a practice that has had the effect of stripping wealth from the same communities that have been so hard hit in the recession. And we appreciate the opportunity to speak and the focus on this issue today.
Thank you, Chris. Paul Mitri from the National Automobile Dealers Association. Sorry, Paul.
Well, thank you, David, and thank you to the CFPB for the opportunity to participate in this morning's program. Discrimination in any market, to include indirect auto financing, has no place in today's society, and NADA fully supports the efforts of the CFPB and other federal agencies to eliminate it from the marketplace. However, as it relates to unintentional disparate impact discrimination, it is important to recognize that these efforts can only be successful if federal regulators engage in several essential steps. First, it is critical that they understand the market they are examining. Second, they must develop appropriate methodologies for accurately measuring whether disparate impact exists in that market. And third, to the extent that disparate impact is found to be present, they must address it in a manner that both accomplishes its purpose and is consistent with the interest of consumers. Of course, as recently noted by Senator Jeanne Shaheen of New Hampshire, it is critically important that the CFPB's efforts in this regard are, quote unquote, done in a fair and transparent way that gives the public an opportunity to weigh in. If the CFPB engages in this essential exercise and responds to the concerns expressed by Senator Shaheen and Senator Rob Portman of Ohio and a bipartisan group of 20 of their Senate colleagues, and we hope that this morning's program is just the first and not the only step in that process, we believe the CFPB will come to recognize certain features of the indirect vehicle financing model that will cause it to reconsider its approach to this issue. First, today's vehicle financing model is extraordinarily efficient. You heard Bill comment on that, and competitive, and provides access to affordable credit to consumers in all credit tiers. This competition is fostered by the ability that dealers currently have to meet or beat the best offer that consumers can secure from other creditors. Second, as recognized and demanded on several occasions by bipartisan members of both houses of Congress, the Bureau needs to identify the complete statistical methodology it employs to measure whether statistically significant disparate impact exists in an auto lender's portfolio. Otherwise, one can have little confidence that the Bureau's model is producing reliable results. This requires, among other things, that the Bureau fully account for neutral, legitimate factors that affect dealer compensation, which are completely unrelated to a consumer's background, and there are several. Third, it is essential that the Bureau fully consider the effect of the statement in its March 21st Fair Lending Guidance that auto lenders can ensure they are complying with the Equal Credit Opportunity Act by, quote unquote, eliminating dealer discretion with the alternative form of dealer compensation identified in the guidance being the payment of a, quote unquote, flat fee per transaction. This compliance step is flawed in two significant regards. First, a broad industry move by finance sources to eliminate dealer discretion through the payment of flat fees will quite simply fail to eliminate dealer discretion. This is because dealers typically sell credit contracts to a variety of finance sources. Each finance source would set its own flat fee, and dealers will have discretion to select the finance source to which they sell the contract. While this may address the fair lending risk of individual finance sources, it will not address whatever fair lending risk may exist for the consumer. Second, a broad industry adoption of flat fees would remove the ability of dealers to, as I said earlier, meet or beat the most competitive offer available to the consumer from any other source. This will weaken competition and in turn drive up the cost of credit. This would adversely affect consumers, particularly credit-challenged consumers, who would lose access to conventional financing for their transportation needs. Democrats and Republicans in Congress have expressed concerns about this, and we hope the Bureau will respond to those concerns by analyzing this undesirable consequence. In closing, we stand ready to work with the Bureau and other agencies in accomplishing our mutual goal of promoting fair lending compliance in a manner that is consistent with the interests of consumers. Thank you.
Thanks, Paul. Batting cleanup, Richard Reese, from what the lawyers in the room think about as the other ABA, the American Bankers Association.
Thank you, David. As the last speaker on the last panel, I figure there's a lot that's been said ahead of me that I agree with, and a few things that have been said ahead of me that I would disagree with. At the risk of being a poor guest, I first want to say thank you to the Bureau for having this forum, but I don't think it substitutes for the kind of engagement that we really need on this issue. It needs to only be a kickoff, and I would have preferred it to be in response to proposed guidance rather than what was passed as final guidance. I think there's a lot to be said for a notice and comment format in this environment. These are important issues that we have been grappling with for a long time. And I think that there's a lot of thought and a lot of study that has been done, but I think more is appropriate to be done. And certainly I picked up my ears some when I heard the director refer to the idea of transparency to the consumers. That kind of disclosure regime sounds like a rulemaking to me, as well as the notion of fair compensation, if in fact there is authority in the Bureau to actually regulate compensation in this industry. That would certainly, I would assume, be a rulemaking situation. Like everyone else, I agree on behalf of ABA and our members, large and small, that we oppose all forms of illegal discrimination, and we subscribe to the policy of ACOA that people must be treated on the basis of their individual qualifications, not on the basis of stereotypes associated with prohibitive basis characteristics. Race, national origin, and gender are all irrelevant to the credit decision, and the track record of our industry through supervision and examinations over decades has demonstrated that we have a great track record in that regard. But this fundamental truth brings us to two major issues in grappling with fair lending law in the auto finance market generally and the practice of dealer premiums in particular, and those are proxies and disparate impact. I think one has to first look at proxies with a certain degree of suspicion because they are very close to, in fact, putting on a stereotypical gloss to individual characteristics. They are useful, and the exam procedures do authorize their use to identify risks, but they are not particularly useful in proving violations. Violations under the law still require, as Supreme Court black letter law is, that the plaintiff must be and must prove to be a member of the prohibited basis group, not likely to be a member, but to be a member of the group. Now, we are all about reducing fair lending risk, and we have compliance management programs to do that, and proxies can be useful in helping us to that shore. But one risk that we should not be managing is a risk that the law will be applied contrary to precedent. Disparate impact is another issue, and we all found out this morning that we're not going to have any quick answer in Mount Holly. In the meanwhile, Reg B does apply disparate impact, and it adopts it by applying the Griggs and Albemarle cases from the Employment Title VII side. This is important, and it stresses once again the importance of individual qualification over criteria assigned by prohibited basis. I think that there's a real danger here, however, of applying it in the prohibited basis area. For one thing, another thing that the exam procedures teach us, or at least the 1999 version and the most recent version of the OCC, is that discretion is not an appropriate area to apply disparate impact. the language of the interagency exam procedures in '99 and the OCC's examination procedures today say a lender's policies of allowing employees to exercise discretion and to negotiate terms or conditions of credit can better be described as the absence of policies or criteria than as a situation in which a policy or criterion generates a disproportionate adverse impact. I think that before we change from that good policy, we should recognize another factor about Regulation B. And Regulation B, in its adoption of disparate impact, has said that it applies to the creditor's determination of creditworthiness. And let me conclude by saying that the discretion that's being applied for compensation that we all agree here, is due dealers, is not a creditor's determination of creditworthiness. That's enclosed in the buy rate. The others have to do with compensation and other factors, but it is not the creditor's determination of creditworthiness. And so I'd say Regulation B restrains the Bureau and all that would enforce it in not applying it to dealer premiums.
Thanks, Richard. And thanks to all the panelists. I lost a big bet today in terms of whether our panelists on this panel, the other panelists, could actually stay within allotted time. It's been a remarkable job. We have really, given where we are, time for one question to discuss.
Was that bet marked up?
If so, it was not transparent, the markup. We have time for one question. So let me ask the panelists, there's been some references this morning on the prior panel and in Director Cordray's remark to possible analogies between the discretionary compensation system that we've been discussing here and yield spread premiums that existed in the mortgage market before the Federal Reserve Board adopted a rule about loan originator compensation. And so I just ask you to comment on what you see as similarities or differences between those markets and the value of the analogies that have been drawn. And maybe we'll just go in reverse order. So, Rich, if you want to start.
Thank you very much, David. Yeah, to me, I think that the primary difference that we see in this situation is that you'll all recall that the narrative around loan officer compensation and its incentives in the mortgage market were around the incentive to steer, around the incentive to put people into products that were not important to them. So we were talking about option arms. We were talking about teaser rate situations and the like. That's not what we're talking about in the auto market. We are not talking about bad loans, loans that are not suitable for people. We are talking about a situation that determines compensation in the loan and in the structure that this is applied. So I think that's a major distinction between the two markets that we're talking about.
Paul?
Quite a bit to say about it. I think in a phrase, apples and oranges, square peg into a round hole. Two entirely different markets. If you look at why action was taken in the mortgage arena, you can see very significant differences. Consider right out of the gate market performance. Think about the situation that prompted additional scrutiny of mortgage originations. Look what was happening to ABS. Look what was happening to defaults and delinquencies. And then look at the auto finance market. Look at it relative to other classes. Has there been an ABS auto default? What about delinquencies? What about the performance generally? Exceedingly well. What about the number of players that are competing for business? Is there any source that exceeds 5% of the market share? So in terms of market performance, the factual predicate for examining this issue in the first place simply is not there. Congressional action. Congress directed the elimination of yield spread premiums in Title 14, Subpart B. No such action was taken with regard to dealer participation whatsoever. Testing. Federal Reserve Board, before they did anything in this regard, tested this issue. That is prudent. They conducted consumer testing to try to figure out what, if any, fix is necessary. No testing whatsoever has been done on this issue. And in terms of kind of the classic things that could create a market failure that would justify regulatory intervention, keep in mind a couple of the things that the Federal Reserve Board found. They found that in the mortgage arena, in addition to a yield spread premium, you also had a payment in addition to that, oftentimes going to a mortgage broker. That created a belief in the mind of a consumer that the mortgage broker was shopping for the best rate for that consumer. And so they were letting their guard down. They're not going out and shopping and taking advantage of the competitiveness of the market. Yet the mortgage broker had no fiduciary duty to the consumer to get a lower rate. There is no such parallel in auto financing. The dealer is not paid a separate fee for arranging financing in addition to dealer participation. There is no basis to facilitate that belief. Alternative forms of compensation. Are there prepayment penalties in auto financing? There are none. They certainly exist in mortgage originations. That was another big concern about things that can confuse the transaction for the consumer. Overall complexity, introductory rates, adjustable rates. You know, in an auto transaction, what you pay in month 1 is what you pay in month 48 or month 60. The first month's payment is the same as the last. There is no switch there. A lot more I'd like to say about this, but the point is, when you look at dealer participation and yield spread premiums, you look at a very superficial resemblance. You get beyond that and start peeling the onion back, and they are worlds apart. And try to superimpose one onto the other is just not prudent public policy.
Chris?
I'm going to surprise folks and disagree. I would say the mechanics of between yield spread premium and dealer reserve may be different, but the impact and the incentives that they create are the same. Rich was talking earlier about the fact that steering people into financial products that they didn't want. I think we have a little bit broader view of steering. That steering is putting someone in a loan that's less advantageous than one that they might qualify for otherwise, and having an incentive to push people into that kind of loan we think is inappropriate. The auto loan market, I will admit, is a simpler market actually than the mortgage market. But that incentive to steer someone into a higher interest rate for compensation still raises the risk that you're putting someone in a loan that's more expensive than that for which they qualify, and frankly is not appropriate for what they need. This can have significant costs to the consumer, and there's very little, if any, way for the consumer to actually know what the impact of that decision is. We've talked a lot about transparency and the fact that we need to have data. We would agree. The problem is that as an individual consumer, it is incredibly difficult to police this marketplace. We've talked. There has been this discussion about meter beating the deal, and the reason I bring this up is that this was the same justification that mortgage brokers used in defending the yield spread system. And what mortgage brokers said was that we can use that yield spread to either pay down fees, or we can use it to meter beat another deal. The way that happens is by reducing their compensation. That compensation was getting made up somewhere else, and usually it was the next person in the door. So the idea that because dealers have discretion to change their compensation means that is an ultimately beneficial thing for consumers is looking at it from a one transaction to one transaction standpoint, not looking at it what its impact could be across the spectrum. And what we know from the previous litigation that Stuart had referred to was that for some consumers who were paying lower rates, it was being subsidized by other consumers who were paying higher interest rates. So we think there are very significant parallels, and we have long advocated well before the financial meltdown that we believe that discretionary pricing schemes were inappropriate in lending markets, that risk-based pricing should be exactly that, pricing based on the risk that an individual consumer presents to a lending entity, and not on the discretion of someone who's purveying it who has an incentive to steer someone into a more expensive interest rate.
Well, it's not going to surprise anybody that I disagree with Chris. But I would say, to kind of get back to what Rich and Paul had mentioned, we're not talking about exotic auto loans. No such thing as an exotic auto loan. The payment structure is the same from start to finish. In the mortgage broker's case, you all just got done with QM rule. Great interest in folks having skin in the game. Mortgage brokers didn't have skin in the game. Auto dealers do. They have inventories. They have to put their own cash on the table in order to keep that business going. They sell other products as well as the financing. And at the end of the day, it's much easier to refinance a car than it is a mortgage. And in order to keep the relationship going with a customer over the long term, the auto dealer has every incentive to try and provide the best deal possible for that consumer.
At this time, we are going to take comments from the audience. The The first individual is Harry Lane with Car Concerns Radio USA.
I talk to the retail automotive consumer on a mass scale every single morning at 9 a.m. on my nationally syndicated radio talk show. I was a new car dealer for over 25 years. I just want to know from the Consumer Financial Protection Bureau, is this really going to have teeth? Are you really going to protect the retail automotive consumer, or is this just going to be a happy talk thing?
Thank you for that question. This is a comment opportunity, and this is the beginning of a hopefully thoughtful process in which we gather a wide range of perspectives to ensure that the Bureau has the benefit of that feedback. Thank you, Mr. Lane. David Ogden with Wilmer and Hale.
Thank you, and thanks for the opportunity to speak this morning. I'm at the law firm of Wilmer Hale. I represent a captive lender in this industry and also have represented automobile dealers. And in another sort of aspect of my life, I've spent a fair amount of time at the Department of Justice, so I've thought about civil rights issues from that perspective as well. I'm a great believer in civil rights, in our civil rights enforcement community, and approach this issue from that perspective. And I do think, in thinking about how you solve what is perceived to be a problem and what certainly is an issue, it is critically important at the regulatory side that you think hard to avoid unintended adverse consequences. And I think it's key to start with this problem with just framing the goal. And I think it's key to think the goal here is to eliminate unjustified differences between car buyers without unnecessarily harming competition and access to credit and access to cars that all of our American people need. And one proposal that's on the table, or one way of supposedly solving the problem, doesn't solve the problem. And that's this idea of flats or set percentages lender by lender. It leaves completely open for the consumer differences between consumers that are justified by nothing other than the fact that they end up taking a loan from one lender rather than another, who may have a different rate and may have a different compensation structure. On the other hand, really urge the consideration of a resolution that the Department of Justice imposed in a matter that I know a little bit about. I think Mr. Rosenbaum alluded to the concept of a process that allows a meeting of competition for specific reasons or other legitimate reasons to discount a rate, but they have to be documented and set forth. That proposal, which the Department of Justice imposed in a case like this, has the virtue of actually addressing the problem, which is unjustified differences. The only differences that remain are ones that are justified. And in the end, you don't, however, eliminate the possibility of meeting competition, which really is as American as apple pie and it's good for everybody. So I hope you'll all consider that the regulators will consider that tried and true idea. Thank you.
Thank you, Mr. Ogden. Tom Domanovsky with the National Association of Consumer Attorneys.
Hello, I'm Tom Domanovsky, and although I'm a member of NACA, I'm at the Legal Aid Justice Center, and I regularly represent low-income car purchases. And in Virginia, these borrowers sign credit contracts in a finance manager's office with disclosed interest rates between 11% to 28%. A common misrepresentation in all my clients' transactions is the car dealer's finance manager telling them, this was the best interest rate we could get for you from the lender. And that is a common misrepresentation that I hear from advocates around the country. It's a personal misrepresentation made between the finance manager and the borrower in the room. The dealer, by the word lender, is referring to the financial institutions that they've prearranged to sell that credit contract to. There's nothing wrong with prearranging to sell the credit contract. There is something wrong with fraud. There is something wrong with the finance manager telling the person, this is the best interest rate we could get for you because it keeps the borrower from negotiating that interest rate. The markup is there, and that markup is hidden from the reach of the marketplace. Because the marketplace can't address the markup, then all kinds of problems happen, including the fair lending risk that discretion is being used discriminatorily. For the marketplace to function properly, the consumer has to be given the accurate information. Until that discretionary pricing is not hidden from the consumer, we can't talk about the marketplace working. So we can have the marketplace work, or we can have regulations work.
Thank you, Mr. Domanovsky. Please join me in thanking our panelists and from the panel perspectives on fair lending risk and indirect auto lending. At this time, I would ask them that they rejoin the audience. And I would invite CFPB staff to offer closing remarks. Following closing remarks, there will be an opportunity for closing comments from the audience. You'll hear today from Patrice Ficklin, the Assistant Director for the Office of Fair Lending and Equal Opportunity, as well as Eric Reusch, who is with our Research, Markets, and Regulations Division. Eric and Patrice, you have the floor.
Thank you, Zixta. I really do want to reiterate the appreciation I expressed at the beginning of this forum for the participation of folks here. It certainly has been some rich and interesting feedback shared. Wanted to just sort of touch on something that I said in my introductory remarks. I mentioned that since we released the auto bulletin, that I mentioned in my introductory remarks earlier, since we released the auto bulletin in March, as you can imagine, we've had a lot of folks who've been interested in talking with us about the bulletin, about implementing it, particularly trade associations and individual lenders. And Eric and I would like to share some of the themes that have emerged from these meetings, with a focus on the feedback from lenders as they've considered what actions they might take to address those fair lending risks that we identified. As many of you will recall, the Bureau's Auto Bulletin discussed the value of a robust fair lending compliance management system, and we've heard some discussion about that today as well, in order to minimize fair lending risk, including the risk arising in an indirect lending business that provides for discretionary markups and pays compensation or reserve based on the size of the markup. As has also been cited in earlier comments, we noted other steps that lenders may take to minimize this fair lending risk, and we said, quote, including but not limited to eliminating dealer discretion to mark up buy rates and fairly compensating dealers using another mechanism such as, and I want to pause for a moment, such as a flat fee per transaction that does not result in discrimination. And I paused on the such as because we've gotten many comments, including today, from folks, I think, interpreting our statement as prescribing a specific compensation alternative, a single one, and we'll talk a little bit about why that's not an accurate reading. Since issuing the bulletin, the Bureau has received feedback as well from lenders about what they view as the downsides of the sort of compliance management system that we described. First, some lenders view these compliance management systems as quite expensive. In addition, other lenders who are beginning to implement or simply enhancing their compliance management systems have stated that these systems create friction with the dealers. We've heard quite a bit about the importance of the relationship, a strong relationship between lenders and the auto dealers, and concern about constant interaction between the two, as required by these compliance management systems. Just last week, a major lender at a fair lending conference stated its concern that CMS could require remediation, in other words, this interaction between the lender and the dealer, year after year, if disparate impacts is identified or disparate outcomes are found. We've also heard from some lenders that non-discretionary compensation systems can have significant benefits. They have articulated at least 4 benefits of alternative compensation systems. First, that they could be revenue neutral in the aggregate for dealers. In other words, we would not only be talking about appropriately compensating dealers, but in a revenue neutral sense. Second, that these alternative compensation systems can reduce fair lending risk, which obviously is an important theme of today's forum and the work that the Bureau is doing in this space. Third, that these compensation systems can be less costly than the expense of compliance management systems, at least with regard to monitoring and addressing markup. And fourth, that these alternative compensation systems may mitigate the potential for repeated remediation and repeated interaction with the Bureau, that this sense of perpetual, ongoing monitoring and engagement and interaction with the Bureau may be avoided by adopting alternative compensation systems. As I mentioned earlier, an interesting insight from many of these discussions was that some perceive the Auto Bulletin as endorsing only flat fees as an alternative form of compensation. Some lenders have expressed concern that the flat fee alternative would not fit well within their business model. We've heard some concerns expressed today about potential unintended consequences of a flat fee alternative. Lenders have noted that paying the same amount of compensation for every loan, regardless of size, could adversely impact either the profitability or the price of loans for smaller purchase amounts, as an example of potential unintended consequences. So let me be absolutely clear. The Bulletin does not require the adoption of this type of flat dollar amount for every transaction. We cited flat fee only as an example. And in fact, the Bureau believes that there could be a variety of possible alternatives to discretionary markup. I'm going to hand it over to Eric to talk a little bit more specifically on that point.
Thanks, Patrice. As Patrice mentioned and other people have mentioned throughout the day, the Bureau has been engaged by several market participants asking about the types of, based after the Bulletin, asking about the types of compensation systems that would be acceptable to the Bureau. The answer really depends on the specifics of each lender's individual business. However, we do believe there's one factor to consider when evaluating any alternative compensation system is that the compensation be based upon non-discretionary terms rather than a term that there is discretion or that has the ability to be modified. As we have indicated throughout the day in our experience, permitting discretion in pricing and tying compensation to the exercise of that discretion may often significantly increase fair lending risk. Potential alternative compensation systems could vary in design and sophistication depending on the needs of an individual lender's business. For example, a lender who desired to eliminate discretionary markup but was concerned about the impact of a flat fee system might consider a compensation system in which dealers were compensated on a flat percentage of the amount financed. Alternatively, if that lender were concerned with that a flat percentage system may disadvantage loans of a shorter duration, a lender may develop a hybrid system in which compensation may be tied to both the amount financed and the duration of the contract. Based on our discussions with industry and our initial review of these concepts, we have not found any reason in principle to object to either of these or to a flat fee. Of course, there are unknowns and risks, but on their face, these proposals appear to reduce significantly the fair lending risk that currently exists and to convey significant possible benefits by minimizing, as Patrice mentioned, the constant interaction and friction with both dealers and the Bureau that could result from a compliance management system adequate to avoid fair lending concerns. However, as noted earlier, the specifics matter, and we would consider such proposals in light of lenders' specific data and implementation. Again, I would like to stress that these are merely 3 examples of potential non-discretionary compensation systems that mitigate fair lending risk. There could be many other possibilities. There are a number of issues that lenders may want to consider when assessing any particular non-discretionary compensation system. First, is fair lending risk significantly mitigated by the system? Second, is it clear that the compensation system change does not create any additional harm or create new risk of discrimination? Third, is the proposed compensation system economically sustainable? And as we've heard throughout the day, Again, sustainability, we're viewing sustainability through a lens that should be thought of in terms of all the participants in the ecosystem: consumers, lenders, and dealers. The main idea is that lenders should anticipate and consider the possible impacts of any changes. And with that, I'll hand it to Zixta.
At this time, I'd like to invite our closing comments from the audience. And we'll start with Joanne Barefoot with Treliant Risk Advisors.
Thank you, Zixta, and I'll join in thanking the CFPB for putting the program together today. I think it's been very interesting, and I agree with the comments that this should be part of an ongoing dialogue. I look at these issues from the standpoint partly of being a former regulator and now as somebody who works with a lot of aspects of the industry, and particularly the larger players. And I think it's important to understand that the arrival of the Bureau has catalyzed a massive amount of change in the large players in the industry and the large banks, and that all of them are working very hard at trying to understand what you want them to do and do it. And they're looking for clarity so that they can follow what is wanted. Recognizing that a lot of these issues involve a tremendous amount of discretion and subjective judgment, that in this case we're dealing with these data issues that are not totally nailed down, and also recognizing that for the banks, if there's too much risk and too much uncertainty or too much cost in any type of product area, some of them are going to get out of it. Or reduce it, which is going to reduce competition, access, and harm pricing. So this is an area, I'll try to be real quick, where the Bureau is not just going after outlier practices, but rather seems to be trying to change the model of how this industry performs. And the more that can be done with clarity and reducing uncertainty and really giving good guide rails while also being mindful of the cost burden of clear new rules, I think is the key to it.
Thank you, Ms. Barefoot. Ken Scott with JP Morgan Chase.
I'm with JP Morgan Chase, and I'm responsible for fair lending compliance across. And I thought I'd just add some comments as at Chase is how we think about this issue. At Chase, we're committed to fair lending and treating our customers fairly. And like many of the other participants here, we have implemented a dealer monitoring program. And I thought I'd share some of the feedback we've gotten from the dealers. Universally, I think, as we're talking to our dealer partners, they all say they're very committed to fair lending. They want to treat their customers fairly and are looking to get, to address some of the issues raised by the CFPB. But across the board, dealers have told us that they're not clear how to address the issues raised by lenders with them through dealer monitoring programs that differ in scope and approach. It is also clear, as we talk to various dealers, that the larger dealer groups think about this very differently to the smaller dealers that are out there. The larger dealer groups have the ability to implement these compliance management programs. Some of the smaller dealers, as they're looking at it and thinking about it, the resources that are needed to address this issue are quite large. One other thing I'd like to highlight is, as we think about our dealer monitoring program and we look at, dealer level monitoring, it's not clear how that's going to address portfolio level disparities. And that's one ongoing challenge that we're still wrestling with. And I think folks, as they're thinking about it, some more clarity on that would be helpful from the CFPB. We appreciate the opportunity to participate in this. And, I think we've had a robust discussion here today, and it's the beginning of a dialogue, and I hope it continues. Thank you.
Thank you, Mr. Scott. Jim Tossi, Center for Regulatory Effectiveness.
Thank you. I'm Jim Tossi with the Center for Regulatory Effectiveness. We're a regulatory watchdog group that ensures that regulators issue effective and non-burdensome regulations. I call your attention to a particular statement that the director made today that I think is extremely important. And he said that we're going to use sound statistical policy. I think that's the guts of this issue, because if you use correct statistics, you'll know, one, if there's a problem, and second, you'll know how big it is. Now, in doing that, if you look at the record, it appears that the board is moving towards the use of Bayesian analysis to do this. Now, I don't want to go over Bayesian analysis, sort of boring this time of day. Class is boring at night. But it's a series of statistical techniques to use. Now, it's used in the healthcare area, and but it has some warts, as all statistical things does. And the only way you look at warts is to disclose all of the models and how they're used and how they're done. Now, and I'd urge the Bureau to do that. But there's another thing out there that should be looked at, and there is a little-known act called the Data Quality Act, which I haven't seen used by many. And that act was an act that directed the Office of Management and Budget to issue guidelines that all data disseminated by all agencies had to meet, including independent agencies. Second, every agency in town had to take the OMB guidelines and adjust them to their own. And I compliment the Bureau because the Bureau's guidelines on the Data Quality Act are very good on two important things. One, on transparency, and second, on reproducibility of the data. And it says, the Bureau says in their guidelines, which is binding by a primetime decision, those of you bill by the hour, we're in the center, we don't. The Bureau will make both original and supporting data and the source of the data available to the public. Right on. The other part of any statistical test is reproducibility of the data. And the Bureau went very well there. It says the Bureau will strive to ensure that statistical and financial data disseminated by the Bureau is capable of being substantially reproduced by an independent evaluator. So the Bureau's done it. Now, so the question is, I urge you to do it. And I noticed that a number of congressmen wrote, and I haven't seen any action, but I think if the Bureau would really look at what they've written, I know you're no agency, you may not know all your regs, I think that address some of this. Of course, we always have in reserve what Mr. Rosenbaum said from the Department of Justice. He said he goes around and kicks the tires, and maybe he won't stop at the tires. Thank you.
Thank you, Mr. Tassi. We have a repeat commenter, Tom Domanovsky with the National Association of Consumer Attorneys. Advocates.
The problem with the discretionary pricing on the credit is more than just the credit, because the problem's made worse because the dealer's simultaneously setting the price of the car. The finance manager sits there and at the same time as adjusting the credit terms is adjusting the price of the car on their computer modules. And if any of you go and sit in a finance manager's office and ask them how they use their computer, you will see what they're doing when they're putting together a car transaction. And the dealer then wants to be compensated for the service of arranging credit in the transaction, in the very transaction where they're simultaneously setting the cash price. If the market's going to work effectively in that environment, two things have to happen. They have to disclose to the consumer the service they're providing and the charge for that service, and they have to first ensure a price integrity about the cash price of the car before turning to the credit side of the transaction. That is not happening in the industry at all. So we know from the mortgage industry, there's real dangers of combining the roles of seller of a product and the loan broker or the loan packager of the product. It's how we had tremendous inflated values on loan products in the mortgage industry, and we know what happened in that system. This is not like buying an appliance at Walmart. And I will say that anyone who says, well, you know, when you go to Walmart, you don't ask them to disclose the price that they paid for that thing, that is a silly argument in this transaction. If you're going to talk about the complexity of this transaction, silly arguments don't help. The current reality is a finance manager is alone in a room with a borrower, a very sophisticated person with a lot of computing power, and a borrower who's tremendously excited because they're buying that car that they're going to go out on a date with. Right? That's
Thank
how
you,
we sell
Mr.
cars.
Domanovsky. Ruth Susswain with Consumer Action.
Hi, Ruth Susswine with Consumer Action. I'll just quickly and briefly say we hear from consumers regularly about auto discrimination, and I want to reiterate the points just made by the NACA attorney. It is a lot of pressure to be sitting in a room with a finance manager and hearing this is the best deal you're going to get, and expect that people with no other information, no real information about the actual costs to them, will be able to make a smart, wise decision. So consumers need much more transparency about the costs, and everyone in this room agrees that we need to eliminate discrimination. I think we've heard from NCLC, CRL, and others that there's enough evidence that there is discrimination, and so let's get to the best way to end it. If it's not a flat fee, let's find the right way, because we need to end it.
Thank you, Ms. Susswine. Bill Hempler with the American Financial Services Association.
Thank you, Zixta. In the regulatory panel, Mr. Rosenbaum from the Department of Justice mentioned yet another alternative that the CFPB commentators did not mention in terms of setting a cap that then which would determine compensation that could be reduced if there were documented evidence as to the good business reasons why to do that. I'm curious whether or not the Bureau is entertaining that as well.
Thanks for the comment, Bill. Ira Reingold with the National Association of Consumer Advocates. I finally got that right.
Thanks, Zixta. I didn't want to correct you before. Thanks to the CF. Thank you for having this forum today. This is right in your wheelhouse. I can't imagine an area where the CFPB needs to do rulemaking and needs to do enforcement. Your role at the CFPB is to create fair, transparent, non-discriminatory marketplaces so consumers have an opportunity to be treated fairly. And as I sit here today and listen to the conversation from industry, I've been doing this a long time, and it's deja vu all over again. These are the same conversations we had with the mortgage brokers about how it was so important that yield spread premiums be protected. Apparently, people now recognize that was a bad thing. This is a non-transparent marketplace. It is ripe with discrimination. It is ripe for consumer fraud. And I think you've got a great opportunity with all of the other regulators to both do great enforcement and rulemaking, and I thank you for that.
Thank you, Mr. Reingold. And I'd like to thank all the panelists today. That included federal regulators, members of industry, including auto lenders, auto dealers, and others, as well as consumer and civil rights groups. I also want to thank our audience commenters. They were quite thoughtful, and we appreciate the insight and the feedback. It is important for the Bureau to ensure that we are all hearing you and that we're hearing from as many voices as possible. It is part of our process. And I also want to thank everyone who watched via live stream. That concludes the Bureau's Auto Finance Forum, and we look forward to seeing you all again. Have a great afternoon.